for today's session
This conference will
walkthrough.
now be recorded.
So the link that you would have received, so you need to follow the same link and download the material. Under that, under module 1 to 4, you would find a folder by the name FMCG. So that contains a lot of Excel worksheets, so that you need to download on your machines. So we'll be working on those Excel files today. So just to give you a sense, the file names are starting with par FMCG, and then we have version 0 until version number 15. So there are 16 Excel spreadsheets in total. Hey Michael, uh, so I couldn't understand your question. So do you need the Excel files or you have some other question? Hey Michael, do you need some Excel? Do you need the Excel files that we have to discuss today? Hey, I've just pinged the link to download the material. So in the chat window. So if any one of you has not been able to download the material, you could just click on that link and download the material for today's discussion. So given that I'm the instructor, so I'll be sharing my screen with all of you, and at the same time, you can also work on those Excel files alongside me. So if you wish to just follow me during the session and try your hands later, that is also okay. But if you want to work on those Excel files along with me, that is also fine. So just in case you need to work with me, you can download the material from the link that I just messaged over the chat. Thank you.
Good morning. Good morning.
Yeah, hi. This is Sid. Welcome. So we're just waiting for other participants to join. So we'll get started in another 5 minutes.
Sorry, par dash FMCG. I will download all the 16 for Excel sheets or Excel
That is right.
workbooks.
That's right. That's right. So we'll be working on those Excel files today.
Okay, thank you. Thank you for that.
Hi all, this is Sid. So we're just waiting for other participants to join. So we'll just give 5 more minutes for others to join this session and then we can get started. In the meanwhile, I would request you to download the material for today's discussion. So today we are going to be talking about FMCG case study. So you need to have those Excel files with you. There are 16 Excel files in total that you need to download in your machines. I have messaged the link over the chat to download the material just in case you have not already downloaded this. Thank you. So if you have so if the participants also if you have downloaded the material, under that you would find module 1 to 4. Under that module 1 to 4 there is a folder by the name FMCG. So once you go there you will be able to see those Excel files. So there are 16 Excel files in total. All right, let's get started so others can join. So thanks everybody for joining this session. And today we are going to be talking about the financial modeling case study. So What we have to discuss today is, let me set the background. So today we are going to be talking about a financial modeling case study, and this case study is a little lengthy, so we would need 3 sessions to complete this. So that's the plan, that between 3 sessions we'll be able to complete this financial modeling case study. So how I'm going to do that would be 2 sessions would be on preparation of the financial model from scratch, and the third one would be to use that model for doing the business valuation. So basically the next 3 classes including today is going to be would be focusing upon the financial modeling concepts and the business valuation part. All right. So that's the game plan for today and the next 2 sessions. So just to repeat for other participants who just joined, you need to have Excel files, FMCG case study Excel files with you. So the material was already uploaded in the link that I've shared with you. You need to download those 16 Excel files, and we would be working on those Excel files in a chronological order. And once we work on those Excel files, you would also get a broad idea of how a financial model works. So before I even go to the Excel file and start discussing the financial modeling concept, I want to first take some time to explain what a financial model is. So in the last session we had discussed the Excel functions, and the purpose of discussing the Excel tips was that once we work on the financial model, we would need to work on the MS Excel platform. And while we create financial model, we use a couple of Excel functions, and we need to be clear about the basic functionalities of Excel. So the first class was more to set the background and the platform on which we are going to be working upon today. So let's get started as to what is a financial model. So basically the term is modeling. Modeling term is used when we have to prepare something with proper logics. So if I have to prepare the financial statements of a company, including P&L, balance sheet, and cash flow, then those financial statements can be prepared for 2 categories of period. One category is the historical data, the wherein we focus on the historical financial statements as to how has been the company's financial performance in past. And the second category in the timeline is the future period, wherein we focus on how my future performance is going to look like. So financial modeling is all about creating the financial projections for the future period, right? So if today I need to prepare the financial projections for next 5 years for the purpose of my long range budget, or for quantifying my strategic plan, then I have to prepare a financial model for it. Now a model essentially includes projections in for the financial statements, and given that it is a projected financial statement, it basically starts with a certain set of assumptions and inputs. So if I take a simple example, that in the P&L, if I need the expected net profit for the next 5 years, then to be able to arrive at the net profit, I would need to start with the revenue line. Then I would subtract the operating cost. Then I would subtract any other cost elements that I would need to take in the P&L, and finally I would arrive at the net profit. So how this would start? This would basically start with the projections around the revenue numbers. Now, if I have to prepare the projections for revenue, that would again start with taking the assumptions which are driving that revenue. So if I take a simple example, say I need to project the revenue for a hotel. Now, how a particular hotel would be generating the revenue in future? It'll be generating revenue majorly from the rental income, because when the guests would come and stay in the hotel, then the hotel would be generating rental income out of it. So that is one source of income. Another thing is that apart from the rental income, there could be a possibility that the hotel is having some kind of banquet hall and it is organizing some events. So the another source of revenue over here for a hotel would be to generate income from those events, so which it would be holding in that banquet hall. And then third category is that in a hotel you might have some kind of restrooms. So the hotel would be able to generate some more income from food and beverages department. So basically what I'm trying to tell you is that if I have to project revenue, I would need to individually find out that what is my expected rental income, what is my expected food and beverages revenue, what is my expected event driven revenue, right? And to be able to arrive at that, I would need to take certain assumptions. So I would say that in the last year, my total rental income was $100 million for the complete year. Now, what is my expected rental income for the next year? That will be dependent on the drivers which are giving me this particular rental income. Now, rental income has got drivers which are primarily the number of rooms, right? So how many rooms do I have in the hotel? Number two, what kind of occupancy does the hotel enjoy? So whether it is 50%, 60%, what kind of average occupancy do we have across the year? Number three, what kind of rental per night are we charging? Right? So these three important drivers will help you decide on the rental income that I would project for this. So basically what happens is, to be able to arrive at an output, which is your rental income, you need to take certain assumptions around these factors. So I would have the input drivers including the number of rooms, the rental per night, and the kind of occupancy. So how this works is, I would say that in the last year I was charging a rental of say $100 per night, but this year I'm going to increase, or next year I'm going to increase the rental income, or the rental per night by about 5-10%. Right. Similarly, I would say that in the last year my occupancy was close to 50%, but I expect my occupancy to increase by 5 percentage points in the next year. So my occupancy would look like 55%, or maybe eventually it will increase further to 60%. So all these inputs we would need to take in the financial model. So effectively what happens is, in a model we have three broad categories, right? And that is how we would be working on the model today. Now, the first category is the inputs and assumptions. That what kind of inputs and assumptions we are taking for the financial model. So, and that gives us the starting point, right? Once we have set out the inputs and assumptions for the financial model, after that we would get to the working part, wherein we would do workings relating to operating revenue, workings relating to operating cost drivers, workings relating to the fixed asset schedule, workings relating to the funding part, including debt and equity and all that stuff. So once the working is done, then after that we would get to the output statement, wherein we would prepare the projected financial statements including P&L, balance sheet, and cash flow. So that's how the overall model looks like. All right. Now, this is exactly what we are going to do now in Excel. All right. So that's the background of what we have to discuss. So between today's session and the next session, we will learn how to create a financial model from scratch, wherein we would start with the inputs and assumptions. Once we have set out the inputs in place, we would get onto the working part. And once the workings are complete, we would get to the output part, which includes your P&L, balance sheet, and cash flow. And after that, once you have the solution in front of you, you can use those projected financial statements to do the business valuation, right? So let's get started now. And for this, I would request you to open the first Excel file, which is PAR FMCG version 0. All right. So please open PAR FMCG version 0. So basically there are 16 Excel files in total. I want to explain you how these Excel files have been created and organized. So given that financial model is it requires a lot of steps to follow. So what we have done is that we have given you different Excel files. So step number one we would do in the first version, then step number two we will do in the next version, step number three we'll do in the next version, and so on and so forth, right? So effectively what will happen, whatever solution you would do in one version of the Excel, you would automatically have that solution executed in the next version that you would open. Meaning, whatever we will do in this version 0, and then when we work on the version 1, that version 1 will have the solution of the version 0. Similarly, when you open version 2 will have the solution of version 1, and then the additional steps that we have to follow. So that's how these Excel files have been arranged, just to explain to all of you how we have to create it in a stepwise manner. Now, what we are going to do in this sheet, we have the historical financial data for a company. So this company has already been started about 5-6 years back, and we have the current P&L and the balance sheet of this company for the last 5 years. So what I've done is I've already plotted the historical data for this company in this Excel file. So in the balance sheet, you can see we have got the liabilities side, wherein we have the current liabilities and the non-current liabilities, and then we have the shareholder equity part. And in the asset sides, you have the current assets and the fixed assets, right? So that's the balance sheet structure. And in the P&L side, you would see that this is for an FMCG company which is selling three products: soap, hair color, and detergent. So these are the three categories of the product that this FMCG company is selling. And below that, you have the operating cost items, including the raw material cost, employee cost, power cost, and others. Right? So that's the broad P&L structure of this company. So let us just do a quick read of the case before we start to put these numbers in Excel. So let's spend 5 minutes to read that case so that we are clear on what is included in this. So here is the case about this company. So financial modeling case study, FMCG sector. So looking through the window of his office, Christos was wondering how quickly time has passed by. The day was pleasant, with bright sunshine outside. With a mug of coffee in his hand, he was looking at the day-to-day activities in the premises of Royal Consumer Products Limited, RCPL. So now we are going to be talking about this company's model, which is RCPL. So Christos had just completed his MBA when his father died in the late 2007. Since then, he had taken control of RCPL, a company started by his father. Right? RCPL, a popular name in the eastern coast of the US, operates in fast-moving consumer products segment. It manufactures and sells three products. Number one, soaps in the packets of 100 grams, hair color in the bottles of 250 ml, and liquid detergents in the bottle of 500 ml. So these are the three products that this company is manufacturing and selling. All right. Now we will see how the historical performance of this company has been. That's the information given out here. So since the time Christos took control of the operations at RCPL, the company has grown leaps and bounds. The volume sold across each of the three categories of the product have shown significant growth over the last 5 years. So there is a question that where is this PDF file? So that PDF file is also there in the same folder that you would have downloaded, right? But whatever information is present in this PDF file, that's also executed in the Excel file that you already have. So just in case you just need to, follow it on the screen, that's also fine. Otherwise, in the same folder, you would find this PDF file, which is by the name Financial Modeling Case Study. All right. So let's come back here. So since the time Christos took control of the operations at RCPL, the company has grown leaps and bounds. The volumes sold across each of the three categories of the product have shown significant growth over the last 5 years. So here we have the data on the volume sold for the last 3 years. Last 5 years from FY 2008 to FY 2012. Now, in this case, you need to take an assumption because this case was created some time back. So the historical data is available from 2008 to 2012. So we are going to be preparing projections starting from 2013. I know that 13 has already passed by, but for us, we are going to be starting from 2013
Mhm.
and have the projections from 14, 15, 16, and 7. That's what we are going to do. All right. Now, so after that, we go to the next line, which says, besides, RCPL has also managed to consistently increase the sales prices of its product, primarily because the lack of the competition in the areas wherein it has achieved good marketability. So we have the data around the historical sales volume and the historical sales price, right? Now, what what this guy is doing, what Christos is doing, he's having this discussion with the various departments in his company. So all of the individual heads would be giving him inputs as to how the future is going to look like. So Christos knows that things are no longer going to be as comfortable as they are right now. especially in a situation when a leading listed player in the consumer products area has announced plans to expand in the geographies where RCPL operates. So he's expecting that in the area which it is captured in that geography, there are other players who are expected to come over. So given the changing dynamics of the business, Christos was thinking through the potential course of action he can take to counter the increasing competition. So as a first step, he decided to take control of the situation. He asked his chartered accountant for the historical financial statements of the company. So we have the historical financial data here, which has the revenue and the cost elements and the net profit numbers. So you can see that the revenue of the company in 2008 was close to $402 million, which is now increased to $748 million. Similarly, the net profit or the PAT number, profit after tax number, was just $6 million, which is now increased to $103 million in the last year. All right. And here we have the historical balance sheet data. The company was started with a paid up capital of $550 million, and that has kind of been flat. There has been no equity infusion in the last uh, 5 years. And after that, we have the data around the fixed assets and the current assets. So we'll be talking about this in the Excel file. So I'm just skipping this for the time being. Let's move forward. So while the past performance looked phenomenal, he knew that he, along with his management team, has to constantly improve and think ahead of the curve, lest RCPL should be eaten by the competition. So he was well aware of the fact that however good his team might be, the past performance may not be sustained in future unless he does plan well in advance. So he quickly summoned his sales and the marketing team to seek their inputs on the future sales price points for the various products that RCPL manufactures. So basically now what he's doing, he's having this discussion with the various departmental heads to take their views as to how the future is expected to look like. So he has called his sales and marketing head, and what he's saying that soap segment has seen a high growth phase so far, but due to enhanced penetration in the rural markets, this segment will see a tapering growth rate from the expected 15% in 2013 to 12% in the 5 years time frame. So he's expecting that the next 5 years we will be able to increase the sale in the range of 15%, but it would eventually decline to 12%. And similarly, for the hair color segment, due to lack of fashion consciousness, this segment will at best see a CAGR 0.5% less than the historical CAGR. Now, what is this CAGR concept? We'll be talking about this in a short while. And similarly, for the liquid detergents, we expect that the growth rate would be in the range of about 5 to 6%. So, what is happening now? I'll just take a break here to tell you that what we are doing. So we are basically reading that what is the expectation of the various departmental heads. So the sales head will be able to tell us how the future sales volume is going to look like, how the sales prices are expected to look like. So taking his inputs will be able to create the model for the revenue piece. Then similarly, somebody from the raw material department or the purchase department will be able to tell us that what kind of raw material we have to purchase and what kind of costing we are expecting towards the raw material part. And HR department will be able to tell us that how the employee cost is going to move in the future years. All right. The corporate finance department will be able to tell us that how the capital structure is going to move, what composition we will have for the debt and equity. So all of these pointers would be given to him by the various departmental heads, right? So what we have to do, we have to basically now use their inputs for the future projections and put that in an assumption sheet, right? Now, in order to put that in assumption sheet, what I'm doing that I am first going to start with the historical data. So you saw in this sheet that we have the historical P&L and the balance sheet of the company. So let us start with this step, that let's put the historical P&L and balance sheet in place, and after that we will start to put the inputs. So I have broadly summarized it here, that once you go back to the version 0, we have the P&L and the balance sheet here. So let's go to the P&L sheet first of all, right? So we have the historical 5 year P&L data here. So we have the revenue from three segments or three products: soap, hair color, and detergent. Let's find out what is the total revenue. So the total revenue is, you take the sum of these three cells, right? And That gives you 402 million for 2008 and so on and so forth. So the 2012 sales number is approximately $748 million, right? So what we are doing right now, just to repeat, I've just put the historical P&L and balance sheet here as a starting point. After this, we will start to put the input data, right? So how this is going to work, let me just tell you that we will be following these steps. So first of all, we would put the historical balance sheet and P&L in place. First of all, we'll just put the historical balance sheet and P&L in an Excel file. After that, once we have it, we will analyze the historical data by, and how do you analyze? Maybe by computing certain ratios and looking at the growth rates, that what has been the growth rate in the past, and we would also be able to compute certain ratios like how the performance has been in the past. Once we have analyzed this, then we would get to put the assumptions and inputs for future period. So we are going to prepare the financial projections for next 5 years, right? In this case, so we will start to put the assumptions and inputs for the next 5 years by taking an inference from the historical trend and also the inputs that we will receive from the various departmental heads. So these heads will be able to tell us that how our sales volume is going to move, how the sales price is going to move, how the raw material prices are going to move. All these inputs would be provided by these departmental heads. So along with these inputs, we would also need to look at the historical data, and a blend of these two will help us to put all the assumptions and inputs in place for the future period, right? And once we have the assumptions in place, then we would get onto the working part. So after that, we go to the working schedules, under which, and what do we do in the working schedules? We will basically, prepare the revenue workings. We will prepare the operating cost workings. We will prepare the fixed assets schedule to find out the depreciation and all that stuff. And we would also be able to look at the funding schedule, wherein we focus more on the debt and the equity part, and so on and so forth. So basically, any other schedule, any other working that you would need to do, you would do out here. And once you have the working schedules in place, finally, we will have the output of the model. And the output of the model is nothing but set of three financial statements, including projected P&L, projected balance sheet, and projected cash flow statement. And after the output is ready, we use this output to use the above output to do business valuation. So that's the sequence in which the model is prepared. So these are the steps to follow for preparing any financial model, right? So these are the steps that we usually follow for preparing any financial model. I'll just take a pause here for any questions. Any questions on the sequence that we have to follow? Fair enough. So yeah, so whatever working I'm doing, I'll be sending this to all of you. So just in case you want to focus more on understanding the concepts and you want to look at these files later on, that is also okay. So Irfan, just to answer your question, I'll be sending this Excel file later. And this PDF, it's available. The financial modeling case study PDF is also available in the same folder. All right. Okay. Now, so what we are doing now, we are just starting with the step number one, which is to put the historical balance sheet and the P&L in place, right? So now, I want to take a minute to tell you a bit more about this, what structure we are following. So when you are in the company, so if I'm working in this company, then I would be able to look at a lot of parameters which impact my revenue, which impact my cost and all that stuff. But when it comes to preparing a financial model, we have to prepare schedules based on certain inputs and assumptions, because we are talking about the future period, how my future is going to look like, right? So if you're going to talk about the future, then we have to take assumptions. And that is why, if because the model is based on assumptions, that is why the model prepared by one individual would be different from the model prepared by another individual. So let me take an example. Say I would talk to the sales and marketing head of this company, and I would ask that, what is your expectation about the sales price for a particular product, let's say soap. So he would say that I expect that the sales price would increase in the range of about 5 to 7%. So he would always have an idea like this, that I expect that the revenue or the sales price of soap will increase in the range of about 5 to 7%. Given that it is a projection, it is an assumption about the future. One can never be perfect about it, right? One can only give an idea that my idea is in this particular range. Now, whether it is going to be actually 5% or 5.5% or 6% or 7%, we don't know unless we actually witness that actual period. So the point is, it only gives us a broad idea as to where the business is expected to move. So what happens is that financial model is filled with a lot of assumptions, because for each and every item you will have an assumption in place. There will be so many assumptions in the financial model. That is why one financial analyst might be taking one assumption, another individual might be taking some other assumption. So sometimes what happens is we also ask question to the management about a particular parameter, that how this parameter is going to look like in future, and the management doesn't have an answer. They would simply say that we expect that the the growth in this number, or the way this number has behaved in past, we expect that trend to continue. So they don't give us an answer as to what this number has to be, but they just say that whatever we saw in past, just continue it, right? So that is why we also need to see how the historical performance has been, so that we do a blend of, for assumptions, we take a blend of two things. One, the management assumptions, inputs, and two, the historical trend. And at times, you might also want to look at the market projections. So the management would say that our business is doing well, and but we believe that the addressable market is going to increase. Like for an FMCG company, the target audience is basically everybody, right? All of the people would be using soap, detergent, hair color, etc., barring the fact that a couple of products would be specific to a category of people. But yeah, most more or less, the if the population of a country is expected to grow at 5%, I'm just throwing an example. So if the population is expected to grow at 5%, obviously your addressable market would also increase. So it's not just the management input, it's basically a blend of management inputs, the historical trend, and the market projection, right? So all of these taken together will help us take the right set of assumptions for the financial model. All right. So this is what we are doing right now. That's the first step that we are working upon. We are putting the historical balance sheet and P&L in place. Now, the question is that, what if we are talking about preparing a financial model for a startup company which does not have any historical P&L and balance sheet? So for that also, the process is pretty much the same. The only difference would be we do not have a historical trend to start with, right? But we would need to rely solely on the business plan of the management. And in that case, the management input is of critical importance. So if I'm looking to start a new entity, then I would know that what kind of business I'm expecting to do, right? So what I would do, that let's say I've got $100 million to invest and I want to start a new hotel. So in this case, the management would say that I am going to invest a capital expenditure of $100 million, and I'm going to have a hotel which will be having 50 rooms divided as 20 standard rooms, 20 deluxe rooms, and 10 executive suites. And this is the expected rental that I'm going to charge per night. and this is the expected occupancy. Or we can also do some kind of market research to find out that what is the average occupancy that a new hotel can expect in the initial years, and eventually we increase it year on year. So basically what happens is, except the first step wherein we do not have the historical balance sheet P&L, the rest of the steps would remain pretty much the same, right? Having or preparing a financial model for an already existing company, it becomes slightly easy for us to understand the business model. And we also know that if we have a base to start with, the next year number would be more or less closer to this. So we have an idea, we have a better idea for an existing company. But for a startup company, everything is started from scratch because we do not have a historical period. So we start with taking all the management assumptions, and then we put the broad structure for the future. All right. So let's get to the P&L sheet. So we have put the revenues here. Now under the cost, we have got the raw material cost, employee cost, power cost, packaging, advertisement, commission, maintenance, and insurance premium. Now I want to show you that if I take the summation of this total cost, the total is coming to about, if I talk about year number 2008, the total is $233 million. And out of that $233 million, raw material cost is constituting about $128 million, which is more than 50% of the total cost, right? Almost maybe close to 55-60%. So basically what happens is that in case of an FMCG company, you would usually find that the raw material cost is the most important cost constituent, right? Followed by maybe employee cost and advertisement cost. But the main focus is going to be on raw material cost. Now, what we need to do when you prepare a financial model, you need to identify those factors which have an important bearing on the end result. Like in this case, I've seen that in the operating cost element, raw material cost is about 55% or 60% of the total cost. So we have to pay special attention to the raw material cost. But if you look at the maintenance cost, that is hardly $1 million each year, right? On a total cost base of 233. So effectively maintenance cost is negligible. So I don't have to worry too much about projecting the maintenance cost. I can take a high level assumption for maintenance cost and then move forward. So this kind of analysis will help you identify that what kind of assumptions we have to take. All right. Now let's proceed. We have the EBITDA number, which is revenue minus operating cost. The historical depreciation is given here. So earning before interest and tax would be EBITDA minus depreciation. Profit before tax would be EBIT minus the interest expense on the borrowings of the company. And finally, after this company would pay tax, it would be left with profit after tax, which is your net profit attributable to the equity shareholders of the company. So we have put the historical P&L in place. Let's move to the balance sheet. In the balance sheet, we have two sides, assets and liabilities and equity. So let us start with the liabilities and equity part. Under liabilities and equity, you would have current liabilities, non-current liabilities, and the shareholder equity. So current liabilities are the one which we expect to repay in a short span of time. So usually 12 months. So let me take the summation of all of that to find out how the current liabilities have been moving, right? We have a provision for employees fund, advances from customer, commission payable, and all that stuff out here in the current liabilities part. And in the non-current liabilities, you would see the interest bearing loan. So we have got $0 of secured loan and $500 million of unsecured loan. Now here just pay attention here that the loan is $500 million in 2008, and look at the historical trend. It has been declining by about $25 million each year, which indicates that probably each year the company is repaying an installment of about $25 million, and eventually this loan would be repaid in 20 years. So looks like a long-term loan. All right. So that's how the loan amount is looking like. Now let's get to this, the equity part, the paid up capital and the retained earnings. The sum of these two will give you the total shareholders equity. And finally, the total liabilities and equity would be this plus this plus this, right? That is going to be our total liabilities and equity. All right. Now, Let's get to the asset side. In the assets, you would have two categories broadly. One is the current and second is non-current assets. So under the current assets, you would see cash balance, the inventory that is being kept by the company, accounts receivable, and any other loans and advances that the company would have given to somebody. And that's the total current asset. Under the non-current assets, we are talking about the fixed assets. So we have a gross fixed asset number and an accumulated depreciation number. So if you subtract the depreciation from the gross block, you will be able to figure out what the net block is. The capital work in progress is zero. The investment in maybe some kind of financial investments in the shares of some other company or some kind of mutual fund units is given here in row number 43. So the total assets is equal to total current assets plus total non-current assets including the net block plus the capital work in progress, which is zero, plus investments. All right. So that gives us the total assets part. And you need to make sure that the total liabilities and equity should be equal to the total assets line. So you can see that all of these numbers are matching, right? So that gives us an idea about the historical financial statements. Now let's go to the next version and see that how we are going to analyze the historical data. So as I said, this first step is done. Now we will analyze the historical data by computing certain ratios, right? We would be doing that analysis now. So let's open version number 1. So please open Power FMCG version 1. All right, now let's go to assumption sheet. So what I've done in the assumption sheet is I've listed out certain ratios and parameters for the historical period. Right. So here we have certain assumptions around the current assets and current liabilities data like inventory days, accounts receivable days, and etc. 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 So we'll come back to this point later. Just park this for the time being. And then we have the revenue related assumptions wherein we have data around the sales price and the sales volume. Right. So let's look at the sales price. How has this price moved in the last couple of years? So we have the sales price, which is in USD per packet of soap, $3, $4, and so on and so forth. And similarly, we have the sales price for the second product and the third product. So let us find out how this price has been moving in past. So I want to find out what has been the year-on-year increase in the numbers, right? So if you need to find out the year-on-year increase in numbers, you need to find out that what is my absolute increase, that is F21 minus E21. That's my increase of about $1 divided by the base price of $3. So on the base of $3, I have increased the price by about $1 per packet. That translates to approximately 12.5%. And then you can copy and paste this on the right hand side to find out the year on year growth in the sales price that we have seen, right? So in order to find out the year on year increase in these numbers, you can use this formula to take the current year number minus the previous year number. That gives you the increase absolute number divided by the base year price, so the previous year price, right? So just to put this logic in place, this year on year increase is equal to the current year number minus previous year number divided by previous year number. That's how we can compute this year on year increase. If you want, you can also compute it by taking the current year number divided by previous year number minus 1. So that's one and the same thing, that you take current year number divided by previous year number and then do a minus 1. That will also give you the same result. That's one and the same. So let me just put it here. Or this could be computed like this. That tends to be a shorter formula. So I personally like using this because this is slightly shorter. So if I compute this by using this formula here, so what it is saying is that take the current year number divided by previous year number minus 1. That also gives you the growth percentage. Now here you see that it is showing 8 and 8. It's actually 8, 7.5, and now it has increased to 8. So if I just increase it by one more decimal, then these are the numbers, right? So this is how the sales price of hair color has moved, and we can copy and paste the same formula here to find out how this sales price for detergent has increased year on year. So we have a broad sense of the increase in the sales prices over the last 5 years now. All right. Now we can, given the fact that we have written this formula in a way that it is taking the numbers from the row above, we can simply copy and paste this formula and pull this for the volume as well. So what I've done is I have copied this formula, which is to compute the year on year increase or the year on year inflation percentage in the price. I've taken that formula and I've pasted it over here as well, because I'm also interested to find that how the sales volume in the historical period has increased. So we can see that the volume of soap as a product has increased by about 15% in 2009, 11% in 2010, and 18% in 11 and 18% in 12. So it has seen a solid growth in the volume in the last 4 or 5 years. So we are able to see that and analyze it by looking at this historical data. All right. So what we are trying to do, just to do a recap again, we are trying to analyze the historical data now. We're trying to analyze this historical data. That's the step that we are following now by computing the ratios and looking at the growth rates and the historical trend. That's what we are doing right now. Right. Then we have certain assumptions around the cost, because in case of an FMCG company, because it's a product company, the manufacturing requires a good amount of raw material. So it says that for manufacturing soap, we use acid, specialty chemicals, ordinary chemicals, and perfume. So it says that these are the four products that we use as a raw material for manufacturing soap. And similarly, the same four raw materials are used for hair color. The same four materials are used for detergent. The only difference is the composition, right? So like in case of soap, the acid is 105 milliliter per product, and in case of hair color, this is going to be 255 milliliter of acid per unit of this product. But in case of detergent, this is very high, 505 milliliter per unit of the product. So basically, these are the four raw materials, same raw materials that we use for soap, hair color, and detergent. The only distinction is the quantum or the composition of these raw material components that we use for manufacturing the product, right? And here we have the raw material price in cents per milliliter, that what is our price, right? And here also we have to find out how the prices have increased year on year. So we can just go back and copy this formula, which computes the year on year growth number, and paste it over here. So I don't have to write it a time and again. I can simply paste it in all of these sections because we have already written that formula. What that does is that it takes the current year number divided by the previous year number minus 1. So we are just trying to find out that how these raw material prices have increased in past. So you can see that the acid is increasing in the range of about, in the last 3 years, you can see it is in the range of about 3 to 5%, right? And similarly, the specialty chemical has increased at this rate, and so on and so forth. So this is just giving us a broad sense as to how the historical data has been, right? We're just looking at the historical trend. Now let's look at the power cost, how the power cost has increased. So the power cost is here. Let me take that growth percentage here. So power cost used to be $2 million, it increased to $2.4 million, then 3 million, 3.5, and 4 million. So it has been increasing in the range of about, average is about 14 to 15 to 20% approximately, right? So that has been the average growth in the past 4 5 years. Then we have the packaging cost per unit. What has been the cost per unit of these products in the last 5 years? That is given here. After that, we are just trying to relate the advertisement cost, commission cost, and maintenance cost to the sale. See, what happens is that in case of FMCG companies, and in fact, for that matter, any other company also, the advertisement cost is usually linked to the sale, because the more advertisement you do, the more you are expected to increase your sale, because the purpose of doing some kind of advertisement is to increase our sales only. So whatever cost you would incur on advertisement, you would be able to see the result of that in your sales number. So people tend to spend a portion of your sale on the advertisement cost. So what happens is that if your sale is 100, then they would expect to spend about 4 to 5%, depending on their own internal budget. Also, they would spend X percentage of the sales number on the advertisement. So we are trying to find out that this company has spent so and so $1 million, right? $20 million in this year, $41 million in this year. But let us see that what proportion of the sale it is actually spending, because absolute number will not tell us anything. So once we convert this to a ratio, then we'll be able to analyze that. So what I'm going to do now is I'm going to take this advertisement cost, which is 20 million, and I'm going to compare it to the P&L. And the P&L, you see the revenue for 2008 was $402 million. So this is in $1 million, and the assumption data has shown 20 million in absolute terms. So there is a difference in units. So just be mindful of that once you write the formula. So we are trying to see that if this is my cost, let me convert this to million. And in order to convert this to million, you will have to divide this by 10 raised to the power 6. All right. So if this is 20 million, you will need to, in absolute terms, you will need to divide it by 10 raised to the power 6, so that you can convert this to 20 in million terms. And this I'm going to see as a percentage of sale. So what I'm going to do is I'm going to take this number divided by the sale number, which is there in cell E8 of the P&L sheet, right? Now here comes an Excel logic, that what we are going to do. Let me first show that to you again. What are we going to do? We have to find out the advertisement as percentage of sale. Then I want to see what commission this company is giving as a percentage of sale. What maintenance cost is it spending as a percentage of sale? All that stuff I'm trying to find out. Obviously, maintenance is quite small, but at least look at advertisement and commission. Usually, there is a direct correlation between the sales number and the advertisement cost number, and so is the case with the commission as well. So if your sales increase, then obviously the commission cost would also increase. You will need to pay more sales commission to the sales guys. So what we are trying to do, we are trying to take these numbers which are there in the next row and divide it by sales. Now I want to write a formula in such a way that whatever formula I write in row number 89 for advertisement as a percentage of sale, I should be able to copy and paste it below as well. So I want to copy and paste the same formula for commission cost and over here for the maintenance cost as well. So what I'm trying to tell you is that in the numerator I would have these numbers, but in the denominator, in all of these three rows, this number is going to be sale. So that denominator should be kept constant. So effectively what we are going to do here, we will take this range, take the advertisement cost, divided by a million, right, which is 10 raised to the power 6, and then divided by sales number, which is 402. But I would not take this E8 as is. I would fix it to take E$8. I'm going to fix row number 8, not the column, but row number 8, because the perspective is once I write this formula here and I fix this row number 8, I'll be able to straight away copy it and paste it in these rows as well. So you see that the formula that I've written here is E$8, and here also this is E$8, and here also this is E$8. So this is going to remain the same. So that is the perspective that I want to make sure that this formula we should be able to copy and paste in all the three rows. That is the perspective that we have over here. All right. I'll take a pause here for any questions. Do you have any questions on this? Fair enough. So if there are no questions, I'll move on. So we have been able to see now that advertisement as a percentage of sale is about 5 to 7%, right? Commission we are paying in the range of about 5%, and maintenance cost is very negligible. It's just 0.2%, so it's quite small. So we don't need to worry too much about the maintenance cost, right? So we have analyzed this, and now in future we'll be taking certain assumptions using this logic that we have here. All right. Now let's go to the top and let's try to find out these ratios over here. So what we have to do here, we have to find out the historical data on the inventory days, accounts receivable days, the commission payable days, the accounts payable days. So why we are doing this? We are trying to find out that what kind of inventory we are keeping in the balance sheet, what kind of credit we are giving to our customers, what kind of credit we are receiving from our creditors, after how many days we are paying commission to our sales guys. That is what we are trying to analyze here. All right. So how do you compute inventory days? The way to compute inventory days is we usually, compute it by this logic that inventory days would be equal to the average inventory that we are keeping divided by the cost of goods sold. And in this case, raw material cost is the most important component. So I'm just going to relate this to the raw material cost multiply by 365. That's how we compute the inventory days, right? And if I have to find out accounts receivable days would be equal to average accounts receivable divided by credit sales. In this example, in this case, obviously we don't have a split of cash sale and credit sale. So I'm going to take the total sales multiply by 365, right? That's how we compute the accounts receivable days. If I have to find out, say, commission payable days would be equal to average commission payable divided by commission cost multiplied by 365. That's how we would compute the commission payable days. And finally, if I have to compute the accounts payable days or AP days as we call it, that is going to be the average accounts payable divided by, now these accounts payable are basically related to our creditors, and in this kind of in this kind of company, the major component of the creditors would be basically related to raw material from whom we are buying this raw material. So I would relate this to raw material cost into 365. That is how we can compute this accounts payable days as well. All right. Now let us compute this one by one. The provision, we will talk about that later. Let's do this computation one by one. So I'll just give a minute for you to uh, see this information, and then we'll proceed further. All right. So now how do we compute inventory days? Let's start with this. Now one option is if I have to compute inventory days for 2009. right? We are looking at the historical data. If I have to compute this for 2009, then I have to take an average inventory of 2008 and 2009, right? That's how we work around it. So in order to compute average, what I can do, I can probably take the inventory of current year plus inventory of the previous year divided by 2. That is how we can work out it, right? Another option is we can use the Excel average function. So I can use an average function here, that average of inventory. I'll go to the balance sheet. So we're talking about 2009, right? So I'll have to take an average of 2008 and 2009. So I'll go to balance sheet and look for the inventory number in the current assets, which is 60 in the current year and 36 in the previous year. So I'm going to take an average of these two cells divided by the raw material cost for 2009 that you would find in P&L. In the P&L, we have the raw material cost for 2009 as 163 multiplied by 365. That gives you about 107 inventory days, which means that we are keeping an inventory equivalent to 107 days of raw material cost. All right. So what we have done in order to compute the inventory days for 2009, we are taking an average inventory of 2009 and 2008 divided by the raw material cost for the 2009 multiply by 365. So that gives you an equivalent number of days for which we are keeping an inventory as compared to raw material cost. So if you were to analyze this, you would say that if the total raw material cost for full year is given to me, in 207 divided by 365 is the average inventory that I'm keeping at the end of the year. That is how we need to analyze this number. So if I just copy and paste this formula here, this tells us that this is how our inventory days is looking like for the last 4 5 years. So it was like 107 in 2009, 124 in 2010, 119, and then 111. All right. Okay. Now let's move on to the next one. Accounts receivable. This we are going to relate to the sales number. So what we'll do here, we will take an average of the accounts receivable for 2008 and 9. So let's go to the balance sheet. Let me actually first go to balance sheet, zoom a bit. I hope this is clearly visible to all of you. So let's go back now. The average accounts receivable for 2008 and 2009, average accounts receivables for 2008 and 2009. So the average of 2008 and 2009 would be the average of 33 and 52 divided by the sale or the revenue of 2009, which is 486 million multiplied by 365. So this is how our accounts receivable days are looking like, which means that on an average, we are giving a credit of approximately 30 days to our customers. So a 1 month credit policy is being followed by the company. Now, how this is going to help you for preparing a financial model. So for the future 5 years, we have to take certain assumptions. So what we can do, we can straight away take an average of the last 4 years and say that in the future also, the average is approximately 31 days. So I would say that in future also, my accounts receivable days are going to be approximately 31 days or 30 days. So this can give you a broad hint as to what kind of assumption you should be taking for future. And if the company has any specific plans that the company wants to give some more credit to attract additional customers, so maybe they will increase this 30 days to 40 days, that can be taken out here. But the perspective is we are trying to model it in Excel so that at a later stage, if somebody has to change these inputs, automatically the output would be updated. All right. So that's how we have computed the accounts receivable days. Let us now compute accounts payable days. Now the same logic we will apply here, that we will take the average of the accounts payable for the current year and the previous year. So I'll go to the balance sheet and take the average of 2008 and 2009 for the accounts payable and divide this by the raw material cost, which is 163 in 2009 multiplied by 365, right? So the average of accounts payable divided by the raw material cost for 2009 multiplied by 365. So this gives us an idea that on an average we are getting a credit for a period of about 40 days. So that's the broad range, like 38 days, 43, 42, 37. So on an average, if I have to take, probably for future I would take 40 days of credit for the purpose of modeling, because that's how the historical trend has been. All right. Now, what couple of financial models tend to do, they say that instead of looking at the average for the last couple of years, it's better to take the previous year data as a base, because that indicates recency in the policy being followed in the company, right? So there could be a situation that in the initial years the company was getting 45 days of credit, but now it is getting only 35 days of credit. So it's better that we stick to the later period. So couple of people would tend to actually focus on just the latest year data, while others would say that let us look at last 4 to 5 years trend and then take an assumption for future, right? So both are right, because as I said in the very beginning, that in the financial model the perspective is we take certain assumptions for preparing projections. Now those assumptions are specific to an individual. So long as you're able to justify that assumption, everything is okay. All right. Now let's go to the commission payable days. Commission payable days would be the average commission payable for 2008 and 2009. The average commission payable for 2008 and 2009 divided by the commission cost for 2009, which is 24, multiplied by 365. So this tells us one thing, that on an average we are giving in couple of years, we have given it in 57 to 59 days, approximately you can say 2 months. But in 2010 and 2011 we paid the commission after almost 88 days, which is like 3 months. So we can conclude that usually we give the commission to the commission we give this commission to the sales guys after 2 to 3 months. So if they have generated a sale now, we will be giving them commission after 2 to 3 months, and that's the usual policy, because once you do the sale it takes some time to prepare the MIS and then understand what kind of sales has been witnessed, and then only we process the commission for them. So that's what we see here, that usually this company is following a commission payable day of about 2 to 3 months. So maybe in future, if I have to take an assumption, I could probably take 2.5 months as the basis, which is like 75 days as commission payable days for future years. So you can do that. So these numbers are giving us an idea how the history has been, and now this average is going to be used for future, right? And now the last is the provision for employees
I'm
fund
sorry, Sid.
as a percentage of employee cost. Yeah, yeah, yeah. Please
I'm
go on.
sorry. Could you just show me the formula again for the commission?
For the commission. Okay, just one sec. Yeah, here it is.
Okay, thank you.
Welcome. All right, let's move on. Now, we have one more thing here, which is the provision for employees fund as a percentage of employee cost. See, what will happen that for a couple of balance sheet items, you will be able to know that what is the right basis. Like for current asset, under current assets, we know that we have a good number in the accounts receivable and inventory. And we in account receivable is usually related to the sales and inventory is related to raw material cost, right? But then there would be couple of items for which we may not be able to directly relate to sales or maybe the raw material cost. So commission is a classic example. You saw that commission was linked to just the commission cost, right? If I did not have a split of commission cost in the overall cost element, probably the next best alternative for me could have been the sales number, because commission payable is directly linked to the sale. I could have actually linked to sale as well if I did not have the commission cost number over here. So the perspective is that we need to find out the right logic, right, to relate to these numbers and then compute ratios. And this is what the meaning of ratio is, right? Now, in the balance sheet, you would see there is one item which is the provision for employees fund. Now, provision for employees fund is what? This is basically like end of service benefit. Like once the employees would leave the organization, what kind of retirement benefits they would be given. So for that, what happens is that each and every company prepares some kind of funds. They keep a fund for the employees end of service benefit. So we have those numbers here. Now the question is that what is the right parameter for me to pick from the P&L if I have to do a correlation? So for this, it would obviously be the employee cost. So provision for employees fund, I'm going to link it to the employee cost to see what has been the average percentage over here. And what we do usually is that whenever we pick the item from the balance sheet, we take average of those items from balance sheet. So usually a balance sheet item is picked whenever we pick it, we take an average. The reason for that is the balance sheet is basically as on date position. So if I'm taking the 2009 number from the balance sheet, that indicates the situation at the end of 2009. So what happens is that it doesn't tell us how this item has moved during the year. So that is the reason that if I take the opening balance and I take the closing balance and I take an average, that will give me a broad idea as to how it has moved during the year. Instead of just focusing upon a single year, we should ideally be taking an average of opening and closing. That is why you would have seen here that for the inventory days, I took average inventory. For accounts receivable days, I took average accounts receivable. For commission payable, I took average commission payable. Right? So we take an average of items whenever we focus on any item in the balance sheet. So similarly out here, if I have to compute a percentage, I will take the average provision for 2008 and 2009. So I'll go back to 2008 and 9 in the balance sheet and I take an average of these two numbers. So average of $10 million and $6 million from E9 and F9 divided by the employee cost for the year 2009. So I'll go to the P&L sheet and pick the employee cost, which is $58 million. So against $58 million of cost, we have kept a provision of an average 8 million, which is approximately 13% for the year 2009, then 9.5%, 9.7%, 9.5%. So what we have done here, we are able to see that on an average, it is in the range of about approximately 10%, right? This is approximately 10%. So I would say that this percentage is equal to average provision divided by employee cost. Obviously, the concept of 365 is not applicable here because here we are not computing days, we are computing a percentage. So I've just correlated the provision to the employee cost. So if I have to analyze this, then the average number of 10 and 6 is approximately 8 million. So I would say that on an average, the company is maintaining a provision of $8 million while the cost of the company on the employees is 58 million. So that gives us an average of about 13%. And similarly for the future year, this is in the range of about 10%. So if I have to take projections for this particular item, I would probably take approximately 10% projection for future years. Right? So this is how these numbers are going to be used. That is why it was important for us to do this kind of computation and analyze the historical data. And this will now lead us to the next part, that we set out the inputs in place. We would now set out the inputs and assumptions for future. All right. So I'll take a pause here for any questions that you might have.
I'm sorry. I just need to see that commission payable form again because I don't know why I'm not coming up with it.
Sure. No problem. I'll just show it to you. In fact, I'll show all the formulae.
Yeah, it's strange. I have the same formula, but why am I coming up with different numbers?
So just check the year number if you're referring to the right year, because when you're working the 2009 number, then you should be taking the average of 8 and 9. So just make sure that you're picking the right year. But for the P&L, you need to pick 2009. If you're writing the formula for 2009, the P&L should also be 2009. So just make sure that you're referring to the right year number.
form is the same thing as yours. I don't know. I'll worry about some other time. Okay.
All right, shall we proceed? Okay, let's move on. Now, so we'll take 10 more minutes and then we'll take a break. So I just want to continue this flow and then we'll go for a break of about 10-15 minutes post that. So let's open the next file, which is version 1. So sorry, version 2. So version 1 was already done. So now we go to version 2. Now what we're going to do here, so if I take you back to the first sheet that we started off with, so we have put the historical P&L in place and the balance sheet in place. We have analyzed the historical data. Now we are going to put the assumptions and inputs for the future years. So that's the step now, right? So the next step that we are going to follow here is this. We are going to put the assumptions and inputs for the future period. And as I told you before, that for assumptions, we are going to take a blend of the management inputs, the historical trend, and some kind of a market projection. So whatever information is available, we'll make best use of that and put the assumptions in place. All right. So let's go to this file now. And here on the right hand side, you can see we are going to put these assumptions. So let's start with this only. So inventory. So we computed this in the last version that average inventory days is in the range of about 110 to 115, right? So what you can do, you can take an average of these cells and find that this is closer to 115. So if you want, you can take an average as 115, but if you believe that over a period of time the management expects to reduce the inventory and it wants to proceed with kind of like just in time or maybe closer to that, and we want to reduce that inventory days, you can reduce it gradually by maybe 5 more days each year, so that you reach to 110 or maybe 105 in 3 to 4 years. So it's more of a management call here as to how they want to drive these items. But as a financial modeler, what we are going to do is we will be taking certain assumption here and we'll be creating the linkages in the Excel file, so that once this model goes to somebody, it's just a matter of changing this number there. So we have put say 115. That person might say that, okay, see, I don't want to take 115, I need 110. That person would change it to 110 and the entire model would be updated automatically. So the perspective here is that we need to learn that how we take assumption. These assumptions obviously can be changed by the end user. The person might want to take some other assumption. The person would straight away say that I'm not going to have 115, I'm going to keep only 100 days of inventory. So that's fine, right? But as a financial modeler, if I have to take the best assumption, probably I would say that, okay, the on an average it is closer to 115. I would also take 115. But maybe after 2 to 3 years, I'm going to reduce it by 5 days. So probably I would take 115, 115, and then reduce it to 110 or whatever. If you want to keep it constant, then keep it constant as 115 for next 5 years, right? This is more like a personal decision of the company as to how they want to do it. But as a financial modeler, we can take an assumption which we think is the best. Like over here, if I have to take, probably I will take a simple average of 115 and keep it constant, right? Now, the accounts receivable, same thing you can see here that on an average, the company is getting a credit of about 30 days. So we can take 30 days credit over here. So I will take 30 days in all of these cells, right? For this provision, we just saw that it was closer to 10% in the historical data. So I would probably take 10% assumption for future. Commission, we saw that it was closer to 75 days, probably 2.5 months. So I would want to keep it closer to 75 days. But if the company sees that there is some other competitor who is just trying to poach our sales guys, and because the sales guys are not very happy because of the commission percentage, or maybe because their commission payments have been delayed in past, so the company would say that instead of giving in 75 days, I would give them in 45 days. So that could be an incentive that the company might want to give to their salespeople. So again, this is more of an internal strategy. But if you feel that it's okay to keep 30 days or maybe 90 days of commission pending with us, then you do it accordingly, because you feel that they are not going to go to any other company and we can easily delay their payments and utilize that fund somewhere else. So it's more of a personal call of the company how they want to do the working capital management. And on the accounts payable, we see that it is closer to 35 days, so probably maybe closer to 35 or 30 we can take over here, right? So the essential thing is that whatever input we take, we have a broad sense. We are not just taking any number here and there. We have a broad idea why we are taking this assumption. And what is going to happen at the end, then once the model would be ready, and then at that point in time, we do an interview with the management of the company, or we hold that kind of meeting with the management, and the management gives us certain other input. It is just a matter of changing this 35 to probably say 30 days, and the entire model would be updated automatically, because we are going to have an integrated financial model. It's not that whatever changes I do here are not going to be reflected in the subsequent sheet. So the moment I make a change over here from 35 days to 30 days, it is going to automatically reflect in the subsequent workings and eventually the final output as well. And if I've done the business valuation using it, my business valuation would also be updated on a real-time basis once I update these numbers. Right? So that's the perspective of creating an integrated financial model, that any change in the in the input sheet is going to be reflected in the output section in 1 minute. Right? Now let's proceed. So for the sales price and volume, if you go back to this here, there was a discussion which happened with the sales and marketing team. So if you see here in this paragraph, it was given to us, which is basically a discussion between Christos and the sales and marketing team guy. So it says that the soap segment has seen high growth phase so far, but due to the enhanced penetration in the rural markets, this segment will see a tapering growth rate from the expected 15% to about 12% in 5 years time. So what it says is that in 2003, we expect it to be closer to 15%, but eventually it has to decline to 12%. So if I take an assumption here, I would probably take 15% and I have to eventually reduce it to 12%. So probably this will decline as 15% to 14% to 13% and then probably 12 and a half and eventually to 12. Right? It has to eventually decline. This is what the sales guy expects, that my increase in the sales price of soap, I'm sorry, was this for price or the volume? So this was for the volume, my mistake. I have to copy and take this assumption over here. The price is in the next paragraph. So he's talking about the volume as to what kind of growth I expect, right, for the sales segment. So it has to, for the soap segment, so it has to increase at a rate of 15%, and eventually this growth is going to decline to 12%. Now comes the hair color part. It says that due to the lack of fashion consciousness in the villages, the hair color segment will at the best see a CAGR of 0.5% less than the historical CAGR over a 5-year time frame. So what it is saying, that the assumption that I need to take here, this is going to be basically the historical CAGR minus 0.5%. This is what we need to do. This is what it is saying, that you take the CAGR of the historical data, historical CAGR minus 0.5%. That is what we expect to see. So let us find out how to compute CAGR. So CAGR is basically compounded annual growth rate, or compounded annualized growth rate. Compounded annual growth rate. And this is equal to essentially the last number divided by the first number power 1 by n minus 1. And you would recollect that we had discussed this point in the Excel tips class as well in the last session. So I had discussed the logic behind this. So we are going to compute that now, that my last number is 34 million units of hair color. And this needs to be divided by 28 million power 1 by how many years do we have? So from 2008 to 9 is 1 year, 9 to 10 is second year, 10 to 11 is third year, 11 to 12 is fourth year. So just don't go by the count of the years because we have got 5 years in total, but the number of years over the base year would be 4. So because from 8 to 9 is 1 year of growth, 9 to 10 is second year, 10 to 11 is third, 11 to 12 is fourth. So we're going to take 1 by 4 minus 1. So if I simply do this, this is the CAGR, which is about 5.5%. But the sales guy is saying that I expect it to be the historical CAGR minus 0.5%. So we expect that in future it is going to be 5%. This is what we expect, that in future the historical CAGR minus 0.5% will be carried. So if in the past 5 years I've got 5.5% of growth in the hair color segment, then I would need to reduce it by 50 basis points or 0.5%, and that gives me 5%, which I need to carry for the next 5 years, and that's going to be the expected growth rate in the hair color segment. All right. Now comes the next one, which is the detergent volume. It says the liquid detergents have gained popularity and they'll continue to display a growth rate of about 5 to 6%. So here it's pretty same. They are saying that we expect somewhere between 5 to 6%. So maybe you would like to take 5.5% across. You can take that. If you want to take 5% for a couple of years and probably 6% for a couple of years, that's also okay. The idea is that we just expect it to be between this particular range, right? It's just a projection for the future year. It can never be exact. So we'll take a number between that range and proceed. All right. Now we have taken assumptions around the historical data. Now we need to take assumptions around the historical data. We have already taken assumptions around the volume. We need to take the assumptions around the price now. So that is also mentioned here that RCPL has so far controlled the sales price of these products, but this may not happen in future. So it is saying that it will be almost impossible to increase the price of soap and detergent for the next 2 years. So the company is expecting that because of the competition, we will not be able to increase the price of soap and detergent for the next 2 years. So for the next 2 years, if you have to take an assumption, it is going to be 0% for both soap and detergent. It is going to be 0% for next 2 years. And even beyond that, the increase is going to be limited to just 2 to 3%. So it is expected that it is going to be just between 2 to 3%, maybe 2.5 and 3%. And similarly, I can take about 2.5 and 3% after it, because the perspective is that the increase in the sales price is going to be zero for next 2 years, and after that, just between a range of 2 to 3%. So any number between that range would work, right? So that's how we are projecting the price. Now comes the hair color segment. Hair color segment still has a possibility of seeing a price CAGR growth rate same at historical levels, right? So we need to find out that what has been the historical price CAGR. So the historical price CAGR is, it was about $10 per unit divided by $8 in the first year raised to the power 1 by 4 minus 1. So we're trying to compute the CAGR of the hair color price. So it has grown at a rate of about 6.1%, and we expect that it to continue in future as well. So we are expecting that the price of hair color would continue to display the same growth rate as we have witnessed in past. So in past we have seen about 6.1% growth rate, and the same growth rate would continue. All right. So we have now kind of listed out the assumptions for the hair color, soap and detergent and all the products over here. So we've got these items. Now let us proceed further with this sheet. Let's go down and now let's put the projections for raw material price. as to what kind of expectation we have for these raw materials. See, what happens is in this case, we have already seen that the company is using four raw materials: acid, specialty chemicals, ordinary chemical, and perfume. So these are the four categories of raw materials that the company is using right now. So we need to see that what the procurement department or what the purchase department feels about these prices, right? So over here, let us say that if you do not have the information from the management, you can either look at the historical trend as to how these prices have been increasing, or you could probably look at some kind of industry report which talks about how the acid prices are going to behave in future, how the specialty chemical prices are going to behave in future. That can give you a broad idea that what kind of increase in raw material price I should be projecting here. So if I take you back to the sheet, I had mentioned here that for the assumptions, you can also look at either the management input, but also you can look at the market projections about that particular item, right? So over here we have some discussion with the raw material guy as well. So let's look at this. So he invited Mr. Andersons, the head of the materials department, for a discussion on the prices of raw material. So what did Mr. Anderson say? So Mr. Anderson said that for the assets, RCPL has entered into a long-term contract with a leading supplier in the region. So what has happened that the company has already entered into a long-term contract wherein they have agreed as to how this price is going to increase in the next 5 years. So they are saying that under the terms of that contract, the asset will see a price escalation of about 5% for the next 5 years. So it is given to us that as part of that contract, it is going to increase at 5%. So that's it as per the contract. For specialty chemicals, he has multiple vendors. And due to the high bargaining power that RCPL enjoys, because we have got so many suppliers in the market, we believe that the price rise in this segment will be restricted to just 5%. That is our expectation. So here also, we're going to assume somewhere closer to 5%, right? Ordinary chemical. Ordinary chemical will display a price rise of about 15 to 16% over the same time horizon. So it is expected that the price of ordinary chemical will increase at quite a high rate of about 15 to 16%. So maybe 15, 15, 15 and a half, or could be 16% also, right? That is what we expect over here. And finally, for the perfume, it is mentioned that perfume will display the historical CAGR in terms of its price growth. So what has been the historical CAGR? We will compute that 0.8 divided by 0.6 raised to the power 1 by 4 minus 1. 8.4%. That has been the historical CAGR. So in the last 5 years, the price of perfumes have the price has increased at an annualized growth rate of about 8.4%. So we expect this to continue for future as well. So that's the input for raw material prices. So we have kind of listed out the assumptions for sales price and sales volume. And now in the cost segment, we have listed out the assumption for the raw material prices, right? And using the same logic, we can put the inputs for the other items as well. Fair enough. So I just want to reiterate one fact again here, that most of the times when you prepare a financial model, you would obviously be talking to the management of the company to take reasonable inputs for the line items that you have in the P&L, balance sheet and cash flow. But sometimes when you do not receive that input, you can always take an assumption by looking at the historical data or by looking at the market projection. So if you have some information about that industry as to how it is expected to move, you can take that as a basis. Now, let me take an example of, say, employee cost. So if I'm talking about a particular region wherein the inflation is in the range of about 5-6%, so you would also expect your employees to receive an increment of about 5-6%, right? So that's a market rate that you are using in your financial model to take a reasonable assumption for employee cost increase, right? But if you feel that the management is saying that our employees are pretty underpaid and we want to keep them motivated, so the market is going to give them 5%, but we will give them 7%. So we'll take that number. So when you take assumptions for future, it's important that we take a blend of all of that, right? And that's how we decide on these numbers. So let's get to the next part, which is the head count. So under the head count, which is employee cost. Now employee cost is driven by three factors. If I have to list it out here, the employee cost is driven by three factors. One, the number of employees, right? The number of headcount, that is point number one. Point number two, it is the monthly salary that we are giving, or you can say just the salary number, whether it is monthly or annual. So how many people do you have and what kind of salary you are giving to them? And number three, what kind of bonus you are giving to them. So these are the three inputs which will decide on the employee cost, right? So let's look at that one by one. In this case, the company is having three departments: manufacturing department, marketing department, and the corporate employees. So those who are sitting in the corporate, including like the HR staff, the finance people, and those who are in the corporate, right? Including the CEO, CFO, and all that people. So what is the assumption around this? So the discussion on the manpower was done with the HR lady by the name Michelle. So we have this paragraph here which tells us that Michelle told Christos that the manpower count will remain the same for this year. So we do not expect to increase the manpower count in this year, which is 2013, while she has budgeted a headcount increase of 5% beyond. So what she's saying that in the year 2013, we do not expect the headcount to increase, but beyond that, she has budgeted an increase of about 5%. So she's saying that the headcount increase has to be nil for 2013, and after that it has to be 5% year on year. So I've taken 0% and then followed by 5% for next 4 years in this. Right? So that's about the headcount. Then it says the what about the salary? So it is saying, so she's saying that she also indicated that employees have not received any salary hike in this year. So she's saying that we haven't paid any salary hike in this year. So effectively in 2013 the salary hike is zero. The monthly salary or the average monthly salary increase is zero. It is the same. While she has budgeted a 5% hike year on year after that. So she's saying that after that it will increase in the range of about 5%. So she's saying that in the current year we haven't increased the headcount, that is constant. We haven't increased the salary, that is also constant. But for the next 5 years after this, we are going to increase our headcount at a rate of 5% each year. My headcount is going to increase, and at the same time, their salary will also increase at 5% every year. All right. Now, the bonus. She's saying that at least we have to give some amount of bonus. So she's saying that firm will continue to pay 15% of the salary as the bonus in the years to come, unless something unforeseen happens. So she's expecting that we will pay 15% bonus each year. So I've taken the 15% assumption out here for the bonus as a percentage of salary. So that's the input around the bonus component. So we have now got all of these three drivers for the employee cost. So this is what I was telling in the very beginning, that if you have to project a particular item in the financial statement, you have to look at the base drivers. Like in this case, the end result is the employee cost, but we know that employee cost is dependent on headcount as to how many employees we have in the company. Number two, what kind of salary we are giving them. And number three, what kind of bonus we are giving them. So these are the three drivers for computing the employee cost. And we have taken assumption around those three drivers in this particular worksheet. All right. So we are almost done with this sheet. Power cost. Now, for power cost, just in case you don't get any input, it is given in the case that we had this line that power cost will display a growth rate in the range of 10 to 11%. So just in case this increase is not given, just in case this increase is not given, we can assume some sort of inflation rate, because most of the expenses will grow or increase at inflation rate. But over here it is given, so we can take the 10 to 11% over here for power cost. So maybe I would take somewhere between 10 to 11% like this. All right. Now comes the next part, which is your packaging cost, because these products like soap, detergent, hair color, you will need to package it. Soap will go in a packet, hair color will go in a bottle, detergent maybe in some pouch or something. So all of these products will be packaged. So we have a packaging cost here, and here we have the discussion around the packaging cost as well. So Mr. Smith, the guy behind the operations, he told Christos that the price packaging cost will see a meager rise of 2% after remaining constant this year. So it's mentioned here. So if I just highlight this, here it is. So packaging cost will see a meager rise of 2% after remaining constant this year, meaning that in this year the increase is going to be 0%, and after that it's going to be just 2%, right? So after remaining constant for 2013, it is going to increase at a rate of 2% each year. All right. Now, after that, let's look at what is the strategy of the company in terms of the advertisement. So it's given here that Christos knew that RCPL had not been an aggressive advertiser so far. So we haven't done a lot of advertisement. So you can look at the historical data. So what kind of advertisement cost have we incurred? We have incurred about 5 to 6% each year. So 5%, 8%, 7%, 6.5, 6. So we have spent somewhere close to 5, 6% on an average each year. So we need to see now that what is the strategy of the company. The company is saying that in order to increase the penetration of the product and reach wider market, the advertisement spend had to increase, and he has increased the budgetary allocation of advertising spend to about 10% of sales this year, and he decided to raise it to 14% gradually over the next few years. So he's saying that in this year I'm going to spend about 10%, and gradually I'm going to increase it to 14%. So what will happen? It might be, let's say, 11%, 12%, 13%, and eventually 14%. So this is how we are going to gradually increase the advertisement cost. All right. So this is kind of giving us an idea as to how we are going to be spending on advertisement. So the company has an intent that we will gradually be spending more and more on advertisement. So we have gradually increased it. And finally, the commission cost. That's here. So the company is well aware that some competitor might poach our sales guys. So to prevent the retailers and salesmen from partnering with any new player in the area, so Christos knew that he would have to gradually increase their commission to 7% from the current level of 5%. So he's saying that we will increase the current 5% commission to 7%, but in a gradual manner. That's what it says, that we will do a gradual increase. So it's not going to be like 5% and straight away we get to 7. That's not it is going to be. He's saying that we'll gradually increase to 7%. So probably from 5 we will increase it to 5.5%, then 6%, 6.5%, and then gradually we'll increase it to 7%. So that kind of assumption will take for commission as to what percentage of the sale we are going to give in the form of commission to these salespeople. So we have now kind of listed out all the assumptions in place. So let me take you back to this, and then we'll break. We'll take a break. So we have put the assumptions and inputs for the future period now. We are now ready to use these assumptions for creating the working schedules. All right. So let's take a break now. And once we are back, we'll proceed further with the subsequent versions. All right. So let's take a break of about 15 minutes and then be back. Thank you. Yeah, hi, this is Sid. So I think we can get started now. Before I proceed to the next version, just wanted to ask if anybody has got any question on whatever we have discussed until now. Any question relating to any concept that we have discussed until now, if you want me to repeat that. All right, so then let's proceed further. So let's go to next file, which is version 3. So what we will do in the version 3, so we have taken certain assumptions here, that raw material price, or like the other components we have given here in terms of percentage increase. So let's see that how these are going to be used to find out that what will be the expected price in the next 5 years. So that's what we will do in the version number 3 now. So let's open that version number 3. All right, now let's come here and over here, let me just zoom this out a bit. Okay, so we have the assumptions here. So the price of the soap in the last year was $4.5 per unit, or approximately $5 per unit. And in the next row, we have got the percentage increase. Now what happens is, if you need to find out the price in the current year, meaning the current year number, that is equal to the previous year number plus growth percentage. So what we can do is that if this is going to, if some number, base number is given to us as 100, and that 100 has to increase at 20%, so the number will be 120, right? So what do we do is that we pick the previous year number and then take 1 plus growth percentage. Okay, so what we'll do here, we'll take the previous year number from this cell, multiply by 1 plus growth number from the cell below. So we have the percentage increase given in the next row over here. So given the fact that this is 0%, so it's not going to, change, but obviously when this would be increasing, it would change. So let me just, increase it to 1 decimal place for all of these cells so that we are able to see these numbers. Right now you can see that the price was 4.5. It is expected to remain 4.5 and then increase by 2% in the next 2 to 3 years. So it is going to increase to 4.6, 4.7, and 4.8. So the formula that I put here is the equal to the previous year number multiply by 1 plus growth percentage. Okay, now the same logic can be replicated for the hair color and detergent and other items as well. So if I have to just copy this formula here and paste it here and here as well, this will replicate the same logic. Like for hair color, you can see that the same logic has been replicated, which picks the price in the last year of 9.5 multiply by 1 plus 6.5% that we had taken over here for 2013. So this assumption of 6.1% has been used to compute the sales price of all of these products individually for the next 5 years. And that is the logic here, that we pick the current year number as the previous year number multiplied by 1 plus growth rate. Now, if I apply that logic here again, it's going to be volume is given here. So I take the previous year number 1 plus 15% growth. And then we replicate it in the right hand side. Previous year number multiply by 1 plus growth percentage. So write it here and replicate it in the right hand side. And now this formula can be, replicated for hair color and detergent. Same logic can be applied here as well. Okay, now let's move on to the next part. We have the cost assumptions around the raw material prices. So here also we have the last year number multiply by 1 plus growth percentage. Similar formula would be taken here, that we pick the previous year number multiply by 1 plus growth percentage. So what we are trying to do now, whatever assumptions we have taken for all of these items individually for the next 5 years, we are using those assumptions to do the computations, and then these numbers will help us prepare the working schedules for these items one by one. So we have now got the raw material price for acid. Same formula I'll copy and paste for specialty chemical, ordinary chemical, and perfumes. Same formula. The previous year number multiplied by 1 plus growth rate. So that gives us the raw material prices for the next 5 years. All right. Now let's move ahead to the headcount. Now this is interesting. So what we have is under the headcount category, you can see that there are three departments. We have got the manufacturing department, which have got about 4,000 employees in 2012. We have got marketing guys, there are about 900 in the company, and 300 people in the corporate team. So we've got 5,200 employees in total, and the split is here between marketing, manufacturing, and corporate employees. And the increase in the number of employees is given in the row number 70. That increase is given here. So here also I'm going to use the same logic, that my current year number is equal to the previous year number multiply by 1 plus growth rate. But there is a catch here, that if I simply write this formula, that I take the previous year number and do a 1 plus growth, then what's going to happen when I'll copy and paste this formula down, then it is going to take previous year number into 1 plus growth, and the growth is going to take it to the next row. So the reason for this is the growth is given in row number 70. So the formula that I'm writing here, which is 1 plus J70, the moment I paste it down, it's going to become J71, and then it will become J72, which is obviously not right. So what we need to do is, every time I copy and paste my formula down, the reference to row number 70 should not change. So this is not the right way to write the formula. So what I should ideally do over here, when you pick J70, you need to fix this cell J70 in a way that column J is relative but row number 70 is fixed. So the implication of this would be that when you copy and paste this formula on the right hand side, the column J will shift to column K, column L, column M and N, so on and so forth as you go on the right hand side, but the reference to row number 70 would not change. That will remain constant. So even when you copy it down, this will remain the same as row number 70. So let me just show that to you. When I copy and paste it on the right hand side, then it shifts, J70 shifts to K70. So the column is changing. And when I copy it down, the J70 remains J70 because row number 70 has been kept in absolute terms. So row number 70 has been fixed by putting a dollar sign. So that doesn't change. When you go down, that doesn't change. That remains constant. All right. So here we have seen that writing the same formula in a range of cells is also easy when we use the dollar sign properly. So if I had not used this dollar sign here, then I would have been writing different formula for marketing professionals and a different formula for corporate employees. So the same formula we were not able to copy and paste. But just by putting a dollar sign here, we have been able to copy and paste the same formula across the range of cells in different rows. Right? So this dollar sign usage obviously has a good role to play in the financial model. And the same logic we are going to apply here, that we have the sales increment number given in row number 76, but the monthly salaries for these employees has these salaries have been given individually in these three rows. So we'll take previous year number multiply by 1 plus the salary growth number. In this case, row number 76 is going to be fixed while column J will remain relative. So the same logic I'm applying, the logic that I used for the headcount, I've used the same logic for the salary part as well. So because the growth in the salary, that number is given, the percentage hike is given in row number 76, so that row number 76 has to be kept constant while column J will remain relative. All right. So that gives us the monthly salary. All right. This is the formula that I put here. Now, after this, as you go down, we have the power cost data given here. So we have the historical power cost here. So in 2012, this power cost was $4 million, and it is expected that it would increase at a rate of 10%, 11%, and so on and so forth. So what we can do, we can pick this logic that will take the previous year number, multiply by 1 plus the growth percentage that's given in row number 81. All right. So using this logic, we are able to project the power cost for the next 4 to 5 years. And as I was talking about this in the earlier file when we were taking this assumption, so it's given to us that the management expects this growth to be in the range of 10 to 11%. But just in case you don't get this input from the management, then usually the power cost will increase at a certain rate, which is usually the inflation rate. And if there is a change in the scale of the company, meaning there are additional machineries or machines to be used in the company, then obviously there would be a higher cost coming in the power line item as well. So over there, this will even increase further. But in this case, that scale change in the scale has not been, given to us. So we are just assuming that it'll increase at a rate of about 10 to 11% each year. And if you use that 10% growth rate, then this is how our power cost is going to look like. All right. Now comes the next block, which is the packaging cost. So for the packaging cost also, you see that you are able to, look at this average monthly salary block. Here we had 3 rows and the increase was given in 1 row. In the same fashion, we have the products listed out here, that what is the packaging cost for soap, what is the packaging cost for hair color, and what is the packaging cost for detergent. And for these 3 products, the hike is given over here. So we'll have to again keep in our mind that when we write this formula by picking the previous year number and do a 1 plus this growth rate, this row number 87 has to be kept constant. So we'll have to fix this row number 87 by putting a dollar sign here. So effectively what's going to happen when we will copy and paste this formula down to the hair color and detergent, the reference to row number 87 will not shift. However, when you copy and paste this on the right hand side, this reference to column J will shift to column K, L, M, N, right? So that's how we can project the packaging cost by using this growth rate given in row number 87. Right? So we have now kind of taken all these inputs here. So whatever assumptions we had taken for the sales price, sales volume, the packaging cost, raw material cost, and all that stuff, the employee cost. So all those assumptions have been used to compute the base driver. So we have computed that what is the expected sales price over here to begin with. So we also computed along with the sales price, we also computed the sales volume. So now we can use these inputs and blend them together and do the subsequent workings, right? So now is the step that we are going to follow, wherein we will pick all of these numbers and prepare working schedules. So we have completed these 3 steps. We have put the historical balance sheet and P&L in place. We have analyzed the historical data by computing ratios, by looking at the historical trend, the year-on-year growth rate. Then we have taken the assumptions based on the discussion with the management, and also by looking at the historical trend. We have taken those assumptions and now we are ready to prepare the working schedules. All right. So let's open the next version and prepare the revenue build-up. All right, so let's open version number 4 and work on the revenue buildup. So that's version number 4. And here's the sheet for the revenue buildup. Now, one important point that I want to talk about the financial model is when you prepare a financial model, there are certain best practices to follow. So we can't just put these numbers here and there, because at a later stage, anybody who's going to utilize this model has to actually use it in a proper way. So unless we follow those practices, the usability is actually compromised. So one of the best practices of the modeling is that whenever we work on a model, financial model, we should follow the principle of transparency, right? We should follow the principle of transparency. And what is the meaning of this principle of transparency? So what do we need to do in the principle of transparency is that we need to show the base drivers. We need to show these base drivers on the working sheet, right? Do not complicate a single formula to blend the logic. Now, what does this mean? So let's say if I have to compute the revenue, then I can just take price into volume in one cell and do everything in just a single cell, right? So if I have to compute the total revenue of the company, I have to show the base drivers that this total revenue is basically the summation of these three numbers. So I have to show the workings of these three numbers. And now how the sales revenue of soap would be computed? This is equal to price into volume. Now, what is the price? What is the volume? I have to bring it to this particular sheet, because you know what happens is in a couple of cases, not in a couple of cases, but usually when you take the output of the model to the management, they may not be interested to look at Excel. They would simply take a print of this file and then read it during the meeting, right? They would just go through that file. They would just go through that particular sheet during the meeting for any discussion. Now, if you do not show these numbers, let's say these rows are not present in this sheet, you straight away have the revenue number here. Then what will happen for understanding the revenue coming from the soap segment? They'll have to go back to the assumption sheet. They'll have to scroll it here to see that what was the sales price of soap and what was the volume of soap. They'll have to see it in a different worksheet altogether. So if you are in the revenue buildup sheet, then you should ideally follow this principle of transparency and bring all the relevant parameters on this particular sheet. So what is this? That this is basically a simple number which we have pulled from the assumption sheet. So in the assumption sheet, we have already projected that what is the sales price assumption for all of these products, and we have already taken the assumptions around the volume for all of these products. So that's something that we have pulled out here, and now we are going to compute the revenue by doing that multiplication, right? So this is what we call as a principle of transparency, that we need to be transparent in terms of the computation. We just shouldn't, leave the base drivers at various places. We should bring it at one place in the sheet wherein we are going to show the final output. Now, how do you compute this revenue? This is simply the price per packet multiplied by the number of packets. And in this column C, you see that we have given the units, that this is in USD per packet and this indicates the number of packets. But at the top, it is given that all these units are in USD million. So unless other specified, all the financials are in USD million. So it is a good practice that we mention that these numbers are in USD million, right? We need to mention it here. Now, we shouldn't be actually doing this thing that at couple of places we show the data in absolute USD terms, and in some other places we show it in USD thousand, and somewhere we follow USD million. You would see in this model that everywhere, to the extent possible, I'm showing all of these numbers in a constant currency, which is USD, and that too in a constant unit, which is in million. So I'm not changing it here and there. So that's a practice to follow in a financial model. So what we need to do now, we need to take this entire range and write this formula that it's going to be price multiplied by volume, and this will give us the data in absolute USD terms, but we need to convert this to a million. So I would divide it by 10 raised to the power 6, which is basically a million, right? And that gives us the revenue. Let me just put the formula here. And eventually you would find out the summation of all of these numbers. So that's how the revenue is moving, and we had seen it in the case study also that in the first year, 2008, the company's revenue was 402, and in 2012 this is 748. So let me bring you back to this PDF sheet. Yeah, here it is. So it's seen that you'd seen over here that 2008 revenue was 402 million, 2012 revenue is 748, and this is the split of that. And using the same logic, we have basically prepared the projections for next 5 years as well. So you would see that it's not a rocket science to compute this number. It's just that we need to follow the basic rules so that at a later stage, if somebody is going to use this model for decision making purposes, then we should know that where to go, what change to make, and how to do it. So now let us say if somebody has to go back and make changes to the volume, and say when you're having this discussion with the end user, the person might say that, okay, I don't expect the sales volume of soap to increase at 15%. I think this is going to increase at just 5%. So the moment you change this 15% to 5%, automatically this number changes, and eventually this will get reflected in the revenue as well. So now you see that the soap revenue is 159, while when it was 15%, it was 175. So this is all interrelated. Whatever changes we are going to do at a later stage in the assumption sheet, that will be reflected in the subsequent sheets as well. So this leads us to an important point. Again, another best practice of a financial model, that do not use hard coded values in working sheet. So in the working sheet, we should not use any hard coded value. If you have to pick any hard-coded value, you must put it in the input and assumption sheet. That's the only place wherein the hard-coded values have to be put. We should not be putting any hard-coded input in the working section. Now, revenue buildup is basically a working schedule. We shouldn't be using any hard-coded value here. Now, what I mean by this is, so if I am taking the price or a volume here it is a straight pull. If I have to show you this number, this is basically a straight pull from the assumption sheet in cell J29, right? If I take you back here, this is being computed here, and the assumption for this is there in the assumption sheet, which has been taken as 15% here. So if I have to change this 15% to 5%, I have to do it here. I can't just write over here that this is equal to this multiplied by 1 plus 15%. This is wrong, because if we do this, then nobody will get to know that what is the assumption that has been taken, right? But if you go into the input sheet and try to change this 15 to 5%, you would assume that everything has got changed. But eventually in this cell, I've already hard coded 15%. So that change of 15 to 5 in the input sheet wouldn't be reflected in the working section here. So we are basically removing that integration part from the entire model, right? So this is the simple plain logic that in the working section, do not use any hard coded value. So if you have to pick this number, then pick it from the input sheet, right? So do not just hard code any value in the working sheet. All right. So whatever changes you need to do, you need to just make those changes in the hard coded values in the assumption and input sheet, and at no other place. So in the entire model, as I was discussing in the beginning, in the entire model, you would basically start with the first section, which is input. Then you would get to working, and eventually you would have output. That's the sequence in which we prepare the model, right? So whatever numbers that we need to hard code, those numbers need to go into the input section or the assumption section. We should avoid using any hard coded value in the working section or the output section. And obviously output is basically the result, and the working section includes the backup material for that result. All right. So we have now got the working for revenue in place. Let's go to the next step and do the working for operating cost. So now we are at this stage. Let's do the working for operating cost. But before that, any questions on whatever we have discussed until now?
Hello. Why is there FY13E and FY14P?
Oh, okay. You've actually seen that point. Great. So 13, the first projection year is usually called estimate, and the future period is usually called projection. I mean, in English terms, there is no difference, but usually in the financial model, the first year is usually an estimate, because what happens is if I am sitting in the year 2013, then a couple of months would have already passed by. So I would have a portion of the 2013 as actual, and for the rest of the months which are yet to pass by, we would be taking an estimate for it. So that's why it's usually called an estimate. But the subsequent years would be straight away called as either forecast or projection. I mean, again, just having said that, there is no difference in the. If I literally read the difference, if I literally look at the meaning of estimate and projection, both are same. But from the financial modeling perspective, we usually use the term estimate when we have a portion of the year which is actual, and the rest of the period is projected. Then we use the term E.
Thank you.
Great.
Hi, Amardeep. This is Irfan.
Yes, Irfan.
Yeah, I'm having some difficulties in opening the Excel files. Does it require to be, you need to sign in or something? Because, I'm having difficulties in opening the files.
You're having difficulties in opening the. You have been able to download this material, or you're
Yes,
facing issues in download?
I've downloaded the material, but when I open it, the sign for sorry, one second. The sign for enable editing doesn't work, so I cannot go into the file and do editing.
Oh, is it?
Yeah, the
Can I
protected
just
view
request
says.
you? No, because it's not protected, and in fact, I've given 2003 version of Excel so that you can open it in any version of Excel. So even if you're using 2007, you would be able to. You should be able to ideally open it. So can I just request you to close the Excel entirely, close the entire application, go to Task Manager and end the process and try opening it again, because there's no password, there's no protection out here, so we shouldn't face any such problem because
Okay,
it's a
yeah,
2003 version of Excel.
yeah, I will try it later, no problem. I just wanted to clarify that.
Yeah, I mean there is no protection. Just to highlight, there's no protection in the file, so maybe some issue with the Excel application at your
Oh,
end.
okay, thanks.
All right, great. So let's
Hi,
move
this
on
is
to.
Chima here. Sorry.
Yeah, please.
If we because drawing up an integrated financial model, sometimes you would want them to also serve as your financial budget for the year.
Mhm.
So doing them on a year by year basis might not um, suffice when you want to now
Right,
start looking at it on a monthly basis. So how do we
that's
then
right.
incorporate the monthly planning
Okay.
into this?
Great. So basically, what happens is we need to first look at the purpose of creating a financial model. As you rightly said, that one purpose of creating a model could be that we would like to use it as a budget, right? And budget is usually reviewed on a monthly basis. We compare the budgeted data with the actual data on a month-on basis rather than just doing a reactive analysis at the end of the year. So what we can do in that case is that if you want to prepare the monthly projection, then the way we are creating the annual data, you would create the yearly sheets or the yearly columns, monthly columns in all the worksheets. So what will happen, it will basically start with the assumption sheet. So instead of taking just a single year, 2013, 14, 15, as a single year in these columns, you would be taking 12 months for all of these years. And once the data is complete on a monthly basis, then probably at the end for the balance sheet, P&L and cash flow, which is basically your output state, which are your output statements, for them you can do a consolidation, yearly consolidation, and show the yearly summary alongside. So that's a common requirement of most of the clients, that they would like to go for a monthly model or a quarterly model. But the logic, the way you do the workings would remain exactly the same. Just assume that this is not 2013, this is the month number 1, this is month number 2, this is month number 3. In exactly the same way, you would be taking the projections and you would be preparing the related workings. So the sequence and the working schedule, everything will remain the same. Obviously there would be slight difference. If you're expecting your sales price to increase at a rate of 15% per annum, you would need to reduce this number if you're taking this assumption on a monthly basis. So it might happen that you would expect that my price will increase at 15% in the 6th month, or maybe in the 9th month, and in the subsequent, in the remaining months, you will just take it as 0%. So eventually what will happen, the same formula would suffice and serve your purpose, but you need to be mindful of putting the relevant input values for those months. And there could also be a possibility that the you might be interested in preparing a monthly model for the first year, but for the subsequent years you're not interested in monthly model, you just want the yearly projection. So that could also be a possibility. Over there you would split all the sheets into 12 columns for the first year, and the rest of the columns will just be yearly. So to summarize, the approach would remain the same. The only difference would be, instead of having yearly column, you would be having monthly columns. Does this answer your query?
Yes, it does.
Great. Any other question? Fair enough. Let's move on to the next file then. Please open version 5. Now we will work on the operating cost schedule. So we have completed the revenue buildup. Now we're going to the cost buildup. So under the cost buildup, before I go there, in the P&L sheet, I want to show you what are the cost elements that we had discussed. So we had seen that in the operating cost, we have got raw material cost, employee cost, power cost, packaging cost, advertisement cost, and so on and so forth. So we've got a couple of line items under the operating cost. So what you can do is that you need to pick certain big ticket items. So out of the $233 million of total cost in the year 2008, you need to see that what are your big ticket items, and then do a deep dive for those items. Like in this case, raw material cost is almost 55 to 60% of the total cost. So we need to do a detailed working for raw material cost. However, if you look at the insurance premium or you look at the maintenance cost, these are quite small. However, if you look at the inputs for the various parameters, but at the same time we shouldn't be spending too much time in terms of the small cost items. So if I just do a deep dive into the maintenance cost and prepare a detailed working schedule for this, that would probably not make sense, right? So we should be doing some kind of an 80-20 rule, that we focus more on the topmost items which contribute at least 80 to 90% of the total given out here. So out of 233, even if I ignore these two items and I focus more on the rest of the items, still I'm able to fairly cover the overall total operating costs. So the point that I'm trying to make over here is that when you pick the drivers for each of these operating cost elements, you need to focus more on big ticket items, and for the small items you can just take a high level assumption, because even for the small items, even if you take 10% increase or a 5% increase, that's not going to change the overall game. So focus more on big ticket items. So let's start with the first one, which is our raw material cost. So let's go back to the cost buildup sheet and look at the raw material cost. Let me just increase the decimal place here. So here is the so in the beginning, at the first block, we have the raw material prices for 4 raw materials. We have the price in cents per milliliter for acid, specialty chemical, ordinary chemical, and perfume. So as we had discussed earlier, we have got these 4 raw materials that we are using for the 3 products: soap, detergent, and hair color. So we are using, for these 3 products, we are using these 4 raw materials, and we have got the raw material prices for these individually mentioned out here. And in the assumption sheet, we had discussed that how these prices are expected to increase. So if I take you back to the input sheet over there, we had assumed in this block that how these prices are going to move in future, and accordingly, using those percentages, we had computed the expected price. So we have now listed out those prices here. Now the question is that what kind of volume do I need to look at? Meaning, how much acid do I need to buy? How much specialty chemicals do I need to buy? How much perfume do I need to buy? So that is the next question, that what is the volume of this raw material, or the quantity that we should be looking at? That is the computation to be done over here. Because at the end of the day, the raw material cost is nothing but price times quantity, right? So we have the projections already for prepared for the price component. So that has been taken over here. And now we need to look at the quantity. Now quantity is interesting. So how do you compute the quantity of the raw material that you need to buy? The raw material that you need to buy has a direct correlation with the quantity of the sales that you have in the previous sheet. So in this sheet, if I show you, we have the sales volume for the individual products. And these raw materials, acid, specialty chemical, ordinary chemical, and perfume, these raw materials we are going to buy only because we have to manufacture these three products. All right. So what we need to do is we need to figure out that what is the amount of acid. Let us first start with the acid component. What is the amount of acid that I need to buy for 18 million packets of soap? What is the acid that I need to buy for 28 million bottles of hair color? What is the acid that I need to buy for 13 million bottles of detergent? Because I need acid for all of these three products. And what is the quantity of acid to buy that is given in the assumption sheet over here, that this is my volume requirement, that for soap, each packet of soap requires 105 ml of acid. Each bottle of hair color requires 255 ml of acid. So if I just highlight these three numbers, so here we have the quantum of the raw material that I need to procure. So if I know that for each packet I need 105, and I also know that the total number of packets that I'm going to sell is 18 million, then we can straight away compute that what is the total volume of raw material that I need to buy. So effectively what I'm trying to tell you is that the quantity or the volume of acid is basically equal to the quantity required for one packet of soap times total packets of soap, plus similarly quantity required for one bottle of hair color, multiply by total bottles of hair color expected to be sold, plus quantity required for one bottle of detergent, multiply by total number of bottles of detergent that we are expecting to sell. So if you take all of these three together, that will give you the quantity of acid to be purchased. All right. Now, while you write the formula here, you need to be again, very careful in terms of using the dollar sign, because we have almost 10 cells in each row, and we've got 4 rows in total. So there are 40 cells in which we have to replicate this formula. So do not just write one formula which you cannot copy and paste in the subsequent sheets. So in the subsequent rows. So we need to be mindful of writing the formula in a way that we use the dollar sign properly. So what we have to do is I'll write equal to the quantity required for one packet of soap. I'll go to assumption sheet and I have that 105 ml written over here. So I need to buy 105 ml per packet, multiply by how many packets do I need to buy, that is given in revenue build-up sheet. So I need to buy 105 ml for one packet, multiply by total number of packets for soap is 18 million. But the question is, we have to do this computation not just for acid, we have to do this for the other raw material components also, like specialty chemical, ordinary chemical, and perfume. So when you copy and paste this formula down, it is essential that the volume of soap, the volume of hair color, and the volume of detergent, these three volumes are kept constant. Meaning when you copy this formula down, the reference to row number 10 over here, and the reference to row number 11, and the reference to row number 12, these three references should not change. So what I'm going to do is I'm going to fix the row number 10. When I will refer to the quantity of soap, I'm going to fix the reference to row number 10. I'll take you back to this point again once I've done the copy and paste, right? So let's proceed further. Plus the volume required for hair color is 255 ml per unit, multiplied by total number of bottles is given here as 28 million. And finally, we need 505 ml per bottle of detergent, and the total number of detergent bottles that we are expecting to sell is about 13 million. So we would fix row number 12, right? And this will kind of give you the result in ml. This is going to give you the result in milliliter, and we have shown here that we are going to reflect the volume in liters. So I would divide the result by 1000. So that gives us the result in liters. Right. Now let me just copy and paste this formula in the entire range of cells, and then you'll be able to relate to it. Sorry, the one cell I've missed. So it should have been column E. Just a small correction. And here it is. So basically what I had done, I was referring to 2009 while writing the formula for 8. So instead of referring to 9, I should have referred it to column E. So Fair enough. But anyways, I've corrected that here. So how this formula is working, let's analyze that again. So each formula has got three components: the raw material required for soap plus raw material required for hair color plus raw material required for detergent. And when you copy it down, it's again taking the same quantity for soap, same quantity for hair color, and same quantity for detergent. And when you copy it down further for perfume as well, so perfume is required for soap, perfume is required for hair color, perfume is required for detergent. That was the reason that I had to fix row number 10, 11, and 12 in the revenue build-up sheet. All right, that was the reason to do this fixing. If just in case, let me just show that to you, just in case I do not fix it, what is going to happen? This E10 will become E11, then E12 and E13, and we don't have anything in E13. Similarly, this 11 will become 12, 13, 14. This 12 will become 13, 14, 15, which obviously does not make sense. So we have to actually fix these three cells, and that's why I had put the dollar sign over here when I had written the formula. Right, so that's how we are creating a flexible and robust formula. We are creating a flexible and robust formula by making sure that whatever formula we write in the first cell, we are able to copy and paste it in the entire block of 40 cells. And it has happened only because we have used this logic of flexible and robust formula. Right, so let me just show the formula to you for your reference. So that's the formula that I've written in this cell. So I'll just take a pause here for you to look at this information and process, and then we'll move further. All right, so let's proceed further now. So we've got the raw material price, we've got the raw material volume. A multiplication of these two will give us the raw material cost. But that cost is also not that straightforward. The reason for that is we have the volume in liters and the price is in cents per milliliter. So there is a distinction in terms of unit. And also the result has to be shown in USD, and not just USD but in USD million. So there is multiplication, straight multiplication of these two will not serve the purpose because these are in different units. So how do we actually combine all of that? So basically the quantity is given to us, which is in liters. So I need to multiply this with the price, which is in liter. So this is the 0.8 cents, how much this would be in terms of dollar. So in order to convert the 0.8 to dollars, I would need to divide it by 100, right? So cents would get converted to dollar when you divide it by 100. Now the result would be in USD, but per milliliter. So if I need to pay 0.8 cents per milliliter, how much cost I would need to incur for liter? For that, I would need to multiply that with 1000 so that I can convert milliliter to liter in terms of price. And eventually the result would be in absolute USD, but we need the result in million. So we would divide it by 1 million. So by taking division by 10 raised to the power 6. So that gives us the overall raw material cost. So you can copy and paste this formula here and then do it. All right. And then here we can take the summation of all of that. So the total raw material cost is expected to be $128 million, increasing to 232 in FY 2012. All right. So that's how we have computed the raw material cost. All right. Let's move ahead with the next thing on the sheet. Next is the employee cost. Now, employee cost, as I had explained this before as well, that employee cost is equal to summation of two things. One, the salary plus bonus. Now, let's say if the salary, just taking an example, if the salary is equal to say 100 and the bonus is at a rate of 15%, then the bonus amount will be equal to 15% of this, right? So if salary is 100, then bonus amount will be equal to 15% of this. And eventually the summation would be 100 plus 15. That is going to be your total employee cost. So what I'm trying to tell you is that if I need to compute salary, I need to take not just the salary but the bonus as well. So bonus, what that bonus is going to do, it is going to increase your salary by X percent. So if I've got 15% bonus, then my base salary will increase by 15%. So can I just say that my employee cost is equal to salary multiplied by 1 plus bonus percent, just to simplify the formula? Because if my base salary is 100 and my bonus percentage is 15%, then 1.15 times salary is going to be my total employee cost. That's how I will compute it, right? And this is here in this case we are preparing we are preparing an yearly model. So we have been given a salary which is average monthly salary. So I'll need to make one more adjustment, that when I take salary, I will take monthly salary multiply by 12, right? And this is not just for one employee. I would need to multiply this for total number of employees. So total number of employees multiply by monthly salary into 12 into 1 plus bonus. So that's how this becomes the final formula. So I had to take the salary expense of the company multiply by 1 plus bonus. Now that salary expense would be computed as total number of employees multiplied by the average monthly salary that we are paying to each employee into 12 to be able to convert this to annual number. All right. So this becomes our logic for computing the employee cost. So let me just copy and paste it here for our easy reference. So it's going to be equal to number of employees. So we have the head count here as 4,000 employees in the manufacturing department, multiply by each individual is getting about $1,170 per month, multiply by 12 to arrive at the annual average salary, multiply by 1 plus 15%, because each individual would also get 15% bonus. Now here again there is an Excel catch, that when you copy and paste this formula down, this 4,000 needs to shift to 900, which is okay. This 1170 needs to shift to 1800, that is also okay. But this 15% should not shift downward, because that bonus percent of 15% is constant for all of these three departments, be it manufacturing or marketing or corporate. So I need to make sure that I fix the dollar sign. I fix the row number 33 by putting a dollar sign, right? So we'll take it as 1 plus J dollar 33 and close the bracket. So what's going to happen now, when you will copy and paste this formula, the cell J24 will move from 4,000 to 900. This cell J29 will move from 1170 to 1800, but the reference to J33 will not move down. That is going to remain constant, right? So that gives you the data in the USD, and we need the result in USD million. So we need to divide this by 10 raised to the power 6 so that the result gets converted to USD million. All right. So that gives us the total number, and we can copy and paste it here. Let me pull the formula here. Right, and the total employee cost would be equal to the sum of these three cells. Okay, so that's how we have modeled the schedule for computing the employee cost. So in this case, you have seen that again we have followed the principle of transparency. We have shown what is the headcount, we have shown what is the salary, we have shown what is the bonus. I have all of these numbers computed in assumption sheet, but we have brought these numbers again back to the working sheet so that if somebody is looking at cost buildup and the individual, that person is looking at the employee cost, that person should not go back to the assumption sheet to look at the base drivers. So that is why we need to pull those numbers, relevant numbers out here, and the working becomes very clear to the person in the same sheet itself. All right. Okay. Now let's move to the next part as to what is our packaging cost. Now, packaging cost is basically equal to cost per unit multiply by total number of units. Meaning if I have got say a cost of, let me just take you back to the assumption sheet, we have the data here that for each packet of soap we spend about $0.1 for packaging. So for each packet I'm spending 0.1. So I would need to see how many packets do I have for soap, and that is given here in this row. So in 2013, we expect to sell about 38.8 million packets of soap. So for each packet, I'm spending 0.1. So for 38 million packets, I would spend 0.1 into 38 million. That's how I would compute the packaging cost. So what is my cost per unit? That is 0.1. What is the total number of units? That is given in the revenue build-up sheet. So I'm going to go to assumption sheet, pick this 0.1 from here, which is the cost per packet of soap multiply by total number of soaps in 2013. So you just need to be mindful of the year number that you pick, because if you see here, we are basically writing the formula for 2013 and which is given in column J. So in assumption sheet, I need to refer to the same column, which is 2013, and in the revenue buildup from where I'm picking the total number of soaps to be sold, that is also in column J, which is 2013. And that will eventually give you the result in absolute USD. However, we need to show the result in USD million, so we would divide this by 10 raised to the power 6. All right, so that gives us the total packaging cost, and we can copy and paste this formula everywhere to generate the result. So let me just put the formula here. All right, so the total packaging cost is this much. Fair enough. So I've got all the cost elements here. So we need to just put the summation here to be able to find out the total cost. So my total cost is a summation of raw material cost, which is there in row number 21, plus employee cost, which is there in row number 39, plus power cost, which is there in row number 41, plus packaging cost, which is in row number 47, plus advertising cost, plus commission cost, plus maintenance cost, and plus insurance cost. These inputs are zero right now, but obviously once we will model them, they'll flow over here and we'll be able to see the result. So right now it is blank, that is okay, but at a later stage, once we put the inputs in the model, we would see these numbers. So right now we haven't computed the advertising cost. So we will do that later once we put that over there. So what I've done here is I've at least modeled all of the items that we need to pick here, right? So if I have to show you an idea that how this is going to reflect, like advertisement cost is 0 right now, but how this is going to work. So if you go back here, if you remember what we were discussing for the advertising cost, that it will be 10% or 11%, and gradually we will increase it to 14% of revenue. So we have written a formula here that it is going to pick revenue from the P&L sheet, and it is going to multiply that with 10%. So right now, P&L for the future projection that has not been prepared. So once we will, as a next step, once we will prepare the P&L, then automatically in the cost buildup sheet, you will see that this would appear. So that is why it is showing blank right now, but at a later stage, once the model is going to be completed, you will see that in a stepwise manner, these cells will be completed. But at least when you are writing the formula for the total cost, you should be picking all of the cost parameters, because all of these are relevant for the purpose of computing the total cost. All right. So that completes the cost buildup. Now we are ready to plug the P&L number, to plug the revenue number and the operating cost numbers in the P&L. Right. So as a next step, what we are going to do, we're going to plug these numbers in the P&L, because in the P&L, what do you have? You have got revenue. We have already computed revenue. You have got employee cost, raw material cost, power cost. We have computed all of that. So we just need to pick those numbers and plug it in the P&L sheet. So at least we'll be able to complete the P&L until EBITDA, which is earning before interest, tax, depreciation, and amortization. So if we have already prepared the schedule for operating revenue and operating costs, we can now at least prepare the model till EBITDA. So let us open the next version, which is version number 5, put these numbers in P&L and see how our operating income is going to look like, right? So let us open the version number 6. Version number 6. So in this sheet, we are going to populate the P&L to the extent possible. Obviously, we wouldn't be able to complete the entire P&L. The reason for that is below EBITDA, you have an item on depreciation, you have an item of an interest expense and tax. We don't have these numbers right now, so we haven't discussed these numbers. So what will happen? This depreciation will come from a fixed asset schedule. This interest expense will come from debt schedule, and the tax will be computed later. So we do not have the fixed asset schedule prepared right now, right? We do not have the debt schedule prepared right now. That is why we cannot proceed further with these numbers, but at least until EBITDA, we are able to do the computation. So that is what we will do precisely over here. So if I have to plug the numbers for the revenue, we have these numbers prepared in the revenue build-up sheet. So I'll just write equal to for 2013, go to the revenue build-up and pick this number from here, which is 175. So the expected sales revenue for 2013 is 175. So I'm going to plug that here, and that populates the table for revenue. So for the hair color, we have got 368, detergent, we have got 278. All of that would be plugged here, and we get the total revenue computation out here in this row. All right. So what we have done here, you have seen that a component of the output has been prepared. So I was talking about the output section. So in the output section, we prepare projected P&L, projected balance sheet, projected cash flow statement. So we have at least started to work on the projected P&L right now. So in the P&L, you have all these items like revenue, operating cost, depreciation, and interest cost. So out of those items, at least we have the revenue workings completed, we have the operating cost workings completed. So we can put those numbers in the projected P&L. So in the output section, you will see that we don't have to do too much of computation because the backup workings are already captured in the working section. So once you go back to this, you will see that over here it is just a matter of pulling these numbers from the revenue build-up sheet. And similarly for the operating cost element also, you will just need to pick it from the cost build-up. Like raw material cost, you will go here and find that this is given in row number 21. So I'll pick it from J21. That's there, right? In fact, let me show you the formula for all of these items. So for the raw material cost, we are taking it from cost buildup. Now employee cost is there in the cost buildup. We just computed that in row number 39. From the operating cost buildup sheet, we will pick this number. The power cost will also be picked from the cost buildup sheet in the row number 41. Packaging cost is there in the cost buildup sheet over here, right? Row number 47 has got the packaging cost. Advertisement cost. Now, before I go to the advertisement cost, let me actually show you. In the previous sheet, I was showing that advertisement cost was blank, but in this case, it will show you a value. I'm sorry, just one sec, because I've shown this formula, it's not getting computed properly. Now it'll be. So over here, you see that advertisement cost has been computed now. In the previous sheet, you were seeing that it was blank, it was zero. The reason for that was the advertisement cost is equal to the revenue multiplied by advertisement percentage. So we have assumed that this percentage is going to be 10%, right? So we have taken the P&L number, we are multiplying this with 10%, and that gives us the advertisement cost of 82 million. So if you go back to the P&L sheet, it is 821. 821 multiplied by 10% will give you the advertisement cost. So that is how it is appearing over there. So now we'll be able to pick the advertisement cost from the cost buildup sheet, which is 82 million in row number 49, right? Now commission is again linked to sales, so we have already computed that in cost buildup. That is there in row number 51. Maintenance cost was assumed in cost buildup sheet in row number 53. And finally, the insurance premium has been taken in row number 55. See, no matter how small a number is, it has to be modeled at least. The only difference is that we can at least take a high level assumption while putting the values for this. So for maintenance and insurance, probably I would take a high level assumption to do this. So that gives us the total operating cost. All right. So all of these numbers will come from the cost buildup sheet. And once you have the total revenue and also the total operating cost, you can just do a subtraction and find out EBITDA. So our EBITDA is equal to revenue minus operating cost, right? It's revenue minus operating cost. Row number 8 minus row number 19. So you can see that in the revenue section, we had three formulae which were like pulling the numbers from the revenue buildup sheet. In the operating cost, we have got these workings, backup workings in the operating cost. For the operating cost in the cost buildup sheet, we have pulled those numbers here. And once you have that, you can compute the EBITDA. So let's complete this. We do not have we don't have the result for the subsequent items, but at least we can write the formula here that whenever I would put the depreciation later, EBITDA minus depreciation will be our EBIT. EBIT minus interest expense will be our profit before tax, and profit before tax minus tax will be our profit after tax. So at least we can write the formula. Right now you see that if EBITDA is 320, all the subsequent items are being reflected as 320. The reason is that we haven't populated the depreciation, interest and tax number. But the moment you populate these three numbers, this formula will automatically capture that. So we have kind of modeled it to the extent possible. So this gives us also a hint that we need to find number one, depreciation. Number two, we need to find interest expense on loan. And number three, we need to find tax. So in order to find depreciation, as I said earlier, you would need to prepare a fixed asset schedule. That what is my fixed asset plan, because that will kind of be depreciated. For this, we will need to prepare a debt schedule to be able to see how my debt is going to be repaid, how I'm going to compute interest on the balance amount. And tax requires you to first compute profit before tax. And once you will put depreciation and interest expense number here, you will be able to find a profit before tax, and that multiplied by tax rate will give you the tax number to be taken. And eventually you'll be able to arrive at net profit. All right. So this way we are able to progress further, that we have prepared everything in the P&L except that we accept the depreciation and the interest part. So for depreciation, we will now proceed with the fixed asset schedule, and for the interest expense, we will proceed to the debt schedule. All right. So let's take a small break here, and let's take a break of 10-15 minutes here, and once we are back, we'll proceed with the final sheet for the day, which is version number 7, wherein we would work on a portion of the balance sheet, and then the rest of the items we will discuss in the next class in the next week. So as I said in the very beginning of this session today, that this is going to be slightly lengthy, because in the two classes we will be completing this model. Once we will have the complete model prepared till this stage, so in the next class we'll be able to complete the entire P&L, balance sheet and cash flow, and also do the ratio analysis. And finally in the last class we will do the business valuation by using this concept, right? So let's take a break now, and once we are back we'll proceed with the last version for the day, which is version number 7. Thank you. In the meanwhile, if you have any questions, I'm here, you can ask me.
Hi, Amardeep. This is Irfan.
Yes, Irfan.
Yeah, Amardeep, just the first session I missed it, and I was not able to go through the video also. So it was only the Excel training, right? The first
So
session.
first session meaning you are talking about the last class?
Yeah.
Okay, yeah, the last class was on the Excel tips, because you know what happens is while we are working on the financial model, you would have seen that I was talking about the usage of dollar sign and writing these formulae. So in
Yeah.
the
Yeah.
first class, we basically discussed the basics of Excel, and also we talked about a couple of Excel functions like VLOOKUP, HLOOKUP, index, match, sum product, wildcard characters. So these were the topics that we discussed in the last class. So we do have a recording of that. So just in case you would like to, receive that, just drop a note to the admin guy. We should be able to share that recording with you,
Yeah. Yeah.
because
They have
that
shared.
might be,
Yeah,
yeah,
they have
that is
shared.
okay, great. So if you've already received it, my suggestion would be that you go through it, because one of the subsequent classes would be on the advanced Excel class, wherein I would be talking a bit on the advanced Excel functions. So over there, this basic concepts would help you understand those advanced concepts. Like just to give you an example, I discussed briefly the concept of index and match, but in the advanced Excel class, I'm going to talk about that in further detail. So it's better that you know the basics of it, so that we work on the advanced practicality part of it. So maybe just go through that once you get time.
Okay. There was one more question that, this we are now talking about the input into the model, right? It's all cost buildup, and it's basically input for the model, right?
Hmm.
Yeah. But
When Sorry, please go on first.
yeah, currently we are working on the input for the model, right? And how the model is created, will we be working on that as well, the later classes?
So basically, when you say how the model is created, you're talking about creating it right from scratch in a blank Excel file, right? Is that what you're referring to?
Yes.
Okay, see, basically, what happens is that right now, for the sake of convenience, for everybody's for each participant, we have got some cells already filled out over here. But structure is something which I will be talking about briefly once the entire model is complete. Because once the model is complete, I'll be able to tell you that what are the best practices that we must follow while you create it. So I'll be talking about that once the model is complete.
Okay. Okay. Yeah. Yeah.
So
Yeah.
hope that should clarify.
Yeah. Yeah. That's fine. Thank you. Thank you.
Great. So, Michael, I see you have a question around replicating a cell calculation across a range of cell. So, what do you mean by replicating it across a range of cells? Do you want to, I mean, is your question that if you have written a formula in one cell, how do you copy and paste it across the entire range? Is that your question, Michael? Okay, great. So the point is, if you have written a formula in one cell, then you can replicate it across the range of cells in this way. There are multiple ways of doing it. So if I just have to, show you, so if I have to, let me just delete this formula. If I have to write the formula for PAT, I would write PBT minus taxes. And once you have written this formula, we basically drag it on the right hand side. That's a conventional way of doing it, that you write it in one cell and then you drag it on the right hand side. But how I was doing it, I was actually writing the formula in the entire range of cells in one go. In order to do that, what you need to do is select the entire range of cells wherein the result is required, and then write the formula usually that you write, and do not press a normal enter. Instead of pressing a normal enter, you need to press control and enter. Once you press control and enter, the same formula gets copied across the range. So that's how we copy and paste the formula in a range of cells that you would have selected. And another approach would be that, once you've written the formula in one cell and you want to replicate it later, you can also select this range and press Control R. When you press Control R, then that's basically like filling the formula towards right side. So that's another way of replicating the calculation in the range of cells on the right hand side. So I'll also take a break for 5 minutes. I'll be back. I'll keep myself on mute. So we'll just start in 1 minute. So just one more sheet to complete today, and then in the next class we'll be completing the entire model. All right, so let's get started. So as I was saying just before the break, that we have been able to complete the P&L to the extent possible. So we have completed the revenue schedule. We have completed the operating cost part. So we have brought those numbers here in the P&L up to the EBITDA line. Now, if I have to go to the balance sheet, now in the balance sheet you have items which range into current assets on the asset side, and you also have the non-current assets, what we call as fixed assets. And on the other side, you have current liabilities and you have the loan apart from the shareholder equity. So what we are going to do now, that fixed asset would be required, fixed asset schedule would be required to bring this number, and debt schedule would be required to bring the loan number, and equity schedule would be needed for equity number. So at least let us do these two components in the balance sheet today. So now what we are going to do, the last thing that we're going to do in the version number 7 is to see how we can project the current assets and current liabilities. Now, the best part about the current assets and current liability is that you don't need a lot of inputs from the management to be able to do the projections for this. So if you just have a look at the historical trend, you'll be able to make sense out of that for the base drivers which are required to be used for the current assets computation and the current liabilities number, right? So let's open the version number 7 and do this final leg. All right. So version number 7 is here. Okay. Now here what we are going to do, we have prepared PNL till this stage. Let me just zoom this in a bit. Zoom out. Okay. And the assumption sheet also. Let me just do this a bit. Fair enough. Let's come back to balance sheet. Now we are going to talk about the current liabilities and the current assets here. Now in the current liabilities line, let us start with provision for employees fund. Now, before I show you the formula as to how we are going to do the projection for provision for employees fund, I want to take you back to the assumption sheet. If you recollect in the earlier versions, we had computed the historical ratios. So we had computed that the average provision for employees fund as a percentage of employee cost was close to about 13.4% here, 9.5 here, 9.7, 9.5. So how did we compute this? I'm just adding a sheet here to show how we computed these percentages. So this percentage was computed by taking the average provision for previous year and current year, and then we divided it by the employee cost of current year. That is how we had computed that percentage. So if I take you here, the formula that we had written over here was that we were taking the average of the provision in the numerator and we were dividing it by the employee cost of 2009. So if I have to show, if I have to compute the percentage for 2009, then I was taking the average of provision for 2008 and 2009 and I was dividing it by employee cost for 2009. This is how we computed this, right? Now I'm going to use this logic for preparing the projected provision for employees fund. So the question is, we are in year number 2013, and for year number 2013 we have to find out what is the provision for employee fund, right? What is the provision for employees fund? That is what we need to find out. So I would use this logic to say that the percentage, so this was for 2009. So if I copy and paste this logic here and I say that instead of 2009 I have to now compute it for 2013, right? I have to compute it for this for 2013. So this will be average of provision for 2012 and 2013, and I would divide this with employee cost for 2013. So I'm just trying to show you the derivation of it. The formula that I'm going to use, I'm trying to show you the derivation of that formula. So what we have done, if I proceed further with this, the percentage for 2013 is equal to average of the provision for 12 and 13. And how do we compute average? Average is provision for 2012 plus provision for 2013 divided by 2. That is how we compute the average. Right? Now the question is, how many variables do we have here? We have the percentage, we have the provision for 12, we have provision for 13, and we have employee cost for 13. Out of these four variables, employee cost has already been computed in the P&L. If I take you back to this, in 2013, the employee cost has already been computed here as $94 million, right? Let's come back here. This is available. Provision for 2012 is already available in the balance sheet. So you see that the provision for employee fund is already available over here. So this component is also available. 13 is not available, and this percentage for 2013 has been assumed that we are assuming that on a go forward basis it is going to be 10%. So out of these four variables, three are known to us. This is 10%, and we are saying we need to find out the provision for 2012, that is 9 million. We don't know what is the provision for 2013, and we are dividing it by 2 and then dividing it by employee cost for 2003, which is 94. So we can do the cross multiplication plus minus, we can get the provision for 2013. So if I have to translate this in the form of a formula, excuse me, so this is going to be, I take this 2 and employee cost on the left hand side, so this will become percentage for 2013 multiply by 2 multiply by employee cost for 2013, and that will make it equal to the provision for 2012 plus provision for 2013. So look at this, and now look at this. What I've done, on the left hand side I have the percentage assumption. I'm going to take it from the right hand side. 2 is in the denominator, I'm going to take it to the numerator. So this division 2 will become multiplication by 2, and this division by employee cost for 13 will become multiplication by employee cost for 13, and that will be equal to this provision for 12 plus provision for 13. So what are we left with? We are only left with provision for 13, so we would need to take this 2012 provision on the left hand side, and this will become minus, and that gives us the provision for 13. So if I just reverse this a bit, then this is going to look like this. If I just simply reverse it, then provision for 2013 is going to look like this. That's what it will be. So effectively, if I have to churn out a formula out of it, can I say that this provision, let me just bring it here only for ease of reference. Can I say that this is the formula, that provision for current year is equal to employee cost for the current year multiply by the percentage assumption for the current year multiply by 2 minus provision for the previous year. That's how I can actually project the provision for employees fund for the subsequent 5 years. And this is not a rocket science here. We assumed this formula, we took this formula while doing the historical trend analysis, and we are just repeating that out here for preparing the projections. So let us use this formula and do the projections for provision. Right? So we'll use this logic that provision for any year for the current year is equal to the employee cost of the current year multiplied by the percentage assumption for the current year multiply by 2 minus the provision for the previous year. So I'll go back to the balance sheet. I'll go back to the balance sheet, and here I would write equal to employee cost for 2013. So look at this. we will go to P&L. I'll pick 94 as employee cost from here, multiply by, go to assumption sheet and pick the percentage, which is 10%, multiply 2 minus, go back to the balance sheet and pick the previous year provision. And that makes it 9. And after that, you can copy and paste this formula on the right hand side. Let me show you the formula here. So that's the formula that I've written. So just to tell you that after the completion of this session, you'll be receiving the recording of this, and I would also be sending the solved Excel files to all of you. So we have got version number 0 until version number 7. So we've got 8 Excel files in total. So I'll be sending those 8 Excel files to all of you, which contains the so these Excel files also contain the notes that I've mentioned while discussing this with you. All right. So coming back to the provision for employees fund, so we have computed that by using this logic that we take the employee cost for the current year from the P&L, multiply by the percentage assumption of 10%, multiply by 2 minus the previous year provision, which is $9 million. That will be subtracted, and this leaves us with a provision for employees fund of about $9 million for 2030. All right. Now, uh, we have some more items in the current assets line. So we have commission payable. Commission payable would be linked to the commission cost. We have accounts payable. Accounts payable would be linked to the raw material cost. If you recollect in the input sheet, we had talked about it. But other than that, we have two more small items, like we have got advances from customer. Now, advances from customer is like we have received certain advance and we are yet to deliver the product to them, right? So if you have received certain advance and we haven't delivered the product, which that means that we owe a liability. So we have a liability there. Now, how do you project it? There's no trend that you can witness over here, and it's not a big number per se. If you see, it's not a big number. So what you can do is you can just assume certain number here. Probably don't assume anything, just assume it to be flat. Maybe you could say that assume flat. So keep it constant, right? Or rather than keeping it constant here, what you can do, you can just go back to the assumption sheet, and over there I have already included advances from customer, and there I have assumed it constant at $7 million because it's a small number. And so is the case with insurance premium payable. That is also a small number of about $2 million. So we have taken that constant over here. So I'm going to just make it equal to the assumption sheet, and in the assumption sheet I've assumed it to be flat. So if I take you back to the assumption sheet, you can see here that we have just made it equal to the 2012 number, and we have kept it constant. So we're assuming this as constant. So whatever number is there in the balance sheet, we're assuming that it will continue as is. It wouldn't change. The reason is that it's very small, and you don't have to worry too much about a small number in the balance sheet. However, other numbers like account payable, account receivable, these are like big ticket items which actually have an important bearing on the working capital part. So those items we are going to project, right? But the small items, you can just keep them constant, right? Now comes the commission payable part. This is again very interesting. If I take you back to the assumption sheet for the commission payable days that we had computed here, you would recollect that what we had done for the commission payable days, I would use the same logic here. Let me just put a separator here. So for the commission payable days, what we had done, we had taken the average commission cost, in fact, average commission payable, and we had divided it by commission cost multiply by 365. This is what we had done in the assumption sheet to be able to compute the commission payable days of 57 days or 88 days or whatever. We had used this assumption to compute the commission payable days, right? Because what we're trying to do here, if you just see that what is my average commission payable outstanding at the end of a particular period, then you divide it by commission cost and figure out that what proportion of that is outstanding. And if you were to translate that in terms of days, you would multiply that with 365, and that'll kind of tell you that approximately, let's say, 60 days of commission cost is outstanding. So this is how we had computed the commission payable days over there. And now we are going to decipher this formula to figure out how to use this logic for projecting the commission payable number in the current assets line. All right, so we are going to now split this formula a bit to say that if I have to figure out the commission payable days, I'm just calling it as CP as a short for commission payable. So commission payable days, if I have to compute for say 2013, I'm going to take the average of commission payable for 2012 and commission payable for 2013. That's how we take the average, and I'm going to divide it by commission cost of for 2013 and multiply by 365. So if I do the cross multiplication again, so what's going to happen that for CP days 2013 multiply by commission cost for 13, because on the right hand side you see this is in the denominator, so on the left hand side this will be multiplied, so this will be multiplied by commission cost for 13, and this 365 is getting multiplied on the right hand side. When you bring it on the left hand side, this will be taken divided by 365, and that will kind of give you the average of CP for 2012 and CP for 2013, right? And how do you compute this average? Average is nothing but commission payable for 12 plus commission payable for 13 divided by 2, right? So if I just write it like this, average will be this plus this divided by 2. So what's going to happen? I know what is the commission payable day assumption. So we have assumed certain number here, which is given like 60 days here. You can see that we have taken an assumption of 60 days. So this is known. Commission cost we have already computed, and the last year commission is known to us. So this is the missing variable. So in order to compute this number, what you can do, you can again do the cross multiplication and figure it out. So the left hand side would pretty much remain the same, right? This division by 2 will become multiplication by 2 here. And the commission payable for 2012 will be subtracted, and that leaves you with commission payable for 2013. So if you use this logic and summarize it, it's nothing but this part. Is nothing but this part, that commission payable for current year like 2013 is equal to commission cost for 2013 multiplied by commission days payable days for 2013 multiplied by 2 divided by 365 and subtract the commission payable for the previous year. So that's the logic for computing the commission payable for the current year. And if I replicate this formula for the accounts payable, for the accounts receivable, or for the inventory, it's going to be exactly the same. So let's have a look at this. This is for commission payable. If I just replicate this for say accounts receivable balance, accounts receivable of current year will be equal to, now instead of commission cost, accounts receivable will be linked to sales, right? Multiply by accounts receivable days multiply by 2 divided by 365 minus accounts receivable of previous year. Exactly the same logic, just that instead of commission payable, if I'm taking accounts receivable, the commission cost will get replaced by sale. Now let's say if I have to do this for accounts payable. Now accounts payable is linked to raw material cost. So I will take raw material cost of current year multiply by AP days multiply by 2 divided by 365 minus accounts payable of previous year. That is how we are going to compute accounts payable. If I have to do the computation for inventory, so inventory of current year is going to be, this is linked to raw material cost, right? So raw material cost of current year multiply by inventory days of current year multiply by 2 divided by 365 minus inventory of previous year. Exactly the same logic would be replicated at all of these places. So if you see that, I've shown you how this formula has been derived, how we have computed the commission payable number in the balance sheet, right? The same logic has been applied for all other current assets and current liabilities number. You just need to find out the right relationship, like commission payable is linked to commission cost, accounts receivable is linked to the sales, inventory and AP, both of these items are linked to the raw material cost. So you just need to put those numbers, but the logic remains the same. And how this formula has come up, you can see it very well in front of you right here. All right. So we will now use these four formulae to compute the commission payable number, accounts receivable number, accounts payable number, and the inventory number. We're going to use these four formulae to compute these four numbers in the balance sheet. Right? So let's get back to the balance sheet now. Let's compute the commission payable. So this is equal to commission cost of current year. So don't worry, I'm going to share this Excel file with you, which has all these formulae. So focus more on the logic part right now. So commission cost for the current year, which is $41 million, multiply by, let's come back. It says you need to pick the commission cost multiply by CP days. So that is there in the assumption sheet. So in the assumption sheet, we have the commission payable days as 60 days assumption, right? Multiply by 2 divided by 365 minus previous year commission payable, which is $6 million. Once you do that, that gives you the commission payable number, and that you can replicate on the right hand side by copy and paste. All right. So we have assumed all of these numbers in the assumption sheet that how my commission payable days are going to move. So these are going to be taken from here, and in the balance sheet we have the previous year number computed right now here. So we have used this logic that we pick the commission cost for the current year, multiply by the CP days, multiply by 2, divided by 365 minus the commission payable for the previous year. All right. So these are the three parameters that we want for commission payable. So we have picked the commission payable from row number 16 here in the P&L, and we have picked the commission payable days again from row number 16 in the assumption sheet. So once you combine these two, you will be able to populate this formula for commission payable. All right. Any questions till this stage? Fair enough. So let's use the similar logic for the accounts payable also. Over here, we are going to take the raw material cost for the current year. So raw material cost is 260. Multiply by, what do you have to take after this? You have to take the AP days. That will be there in the assumption sheet. The AP days assumption is here in J17. Multiply by 2 divided by 365 minus the AP for the last year. And that's how it is going to be computed. And here you can put the total, but just be mindful that once you put the total, please include row number 8 as well, because that's for overdraft, which is blank right now. But once we will model the overdraft value in the balance sheet, the sum should include that as well. So that also needs to be captured here. Okay. And lastly, we will go to the current assets side, wherein we have the formula for inventory. Everywhere we are following the same logic. So pick the raw material cost from the P&L, 260, multiply by inventory days, 115, taken over here, multiply by 2, divided by 365, minus the previous year inventory. So raw material cost for the current year, multiply by inventory days, multiply by 2, divided by 365, minus inventory cost for the previous year. And let's do the same thing for accounts receivable. Here we are going to pick the sales number. Sales is 821 for the current year. Multiply by accounts receivable days assumption, which is 25 days. Multiply by 2 divided by 365 minus the previous year number of accounts receivable, which is $51 million. Deduct that, that gives you the AR number for all of these years, right? So you've seen that in the current liability side, the accounts payable, commission payable, and the provision for employees fund. These three are important elements. Those we computed by using that logic. The rest of the items we assumed constant because those were pretty small and not any, they are not significant enough to be projected properly. So we have assumed them to be constant. And on the current asset side, we have inventory balance, we have accounts receivable balance that we have projected by using this logic. And we also have a small portion in the loans and advances. So probably we have given certain loans to our employees, we have given certain advances to some of our raw material suppliers. So those would be our assets until those are honored. So we don't have a trend for this, so we can basically assume them constant, and I've taken them constant in the assumption sheet over here in the loans and advances part, row number 8. So I've assumed them constant at $16 million because it's not directly correlated to any other factor which is there in the P&L or balance sheet. So it's there is no way that we can project this until and unless we know the clear cut schedule of how this is going to be honored. So the best option is that we can just assume it to be flat. And now we can take the summation of this.
Hello? Hello?
Hi, Sid, are you there?
Hello? Hello?
I guess Sid left us for now.
It seems the voice is gone, Ravi. Hello? Hello?
Well, I think
The voice is gone, I think.
Sid has left, I think.
They're checking, yeah.
Uh,
Hey, I just lost connection in between. Can you see the screen now and hear me properly?
Yeah.
yeah, we can hear you, Sid.
Okay, great. Yeah, okay, thank you. So I just lost the network in between for a minute, so apologies for that. So I'll just repeat the last step that I was talking about before going offline. So what I was saying that I was talking about the loans and advances. So basically for the loans and advances part, what happens is the item, the amount is quite small. And number two, we don't have a direct correlation between the loans and advance and the kind of business that the company is doing. So like inventory has a correlation with raw material cost, accounts receivable has a correlation with the sales that the company is doing, but loans and advances that doesn't have a correlation with any other item. So loans is like we have given some loan to an employee. Advances are like we have given some advances to one of our raw material suppliers and we are yet to receive the raw material. So it's just going to be temporary in nature and we would receive it sometime later. So we don't have a direct correlation of this number with any other item. So the best thing would be that you just avoid taking an assumption for it and keep it constant. So in the assumption sheet, you can see I've made it constant as 16 million and that I've replicated here. And now we can take the sum of these numbers and plot it here. You would see here that when I'm writing the formula for the total current assets, I am taking the cash and cash equivalent number also, right? The reason for that is there is no cash number at the moment, but obviously when we will prepare the cash flow statement and put that number out here, this will be populated. So at that stage, we do not want to go back and change the formula for total current assets. So while you're writing the formula, just make sure that you include that cash cell also, so that at a later stage, once the cash number is populated, it should automatically be picked in the total current assets line. All right, so that completes the current assets and the current liabilities portion in the balance sheet. So that's it for today. Just to summarize what we have discussed until now, we started off this logic here that we would in order to create a financial model, we need the input and then the working and finally the output. So we have put all the inputs in place. We have done two sets of workings. We have completed this revenue schedule and the operating cost schedule. We have done that, and a portion of the balance sheet has been completed and a portion of P&L has been completed. So what we're going to do in the next session is we will be completing the fixed asset schedule, we'll be completing the debt schedule and equity schedule. And once these would be populated, we would be in a position to complete our P&L and balance sheet, right? And once the P&L balance sheet are complete, we can safely create the cash flow statement, which will give us the cash balance at the end of each year, which will be taken back to the balance sheet, which we have just missed right now, right? Because you saw here that the cash balance is missing. So once the cash flow statement would be ready, we would be populating the cash number here, and that would complete our financial model. So that is the agenda for the next class that we're going to have the same time next week. And once the model would be completed, in the session later, we will be talking about the concept of business valuation, wherein we would discuss the DCF valuation methodology and the relative valuation methodology. All right. So that's it for today. And as I said earlier, we'll be sharing the recorded material with you, the recording for today's session, along with the Excel files that I have worked upon during this session. So we have completed version 0 to version 7. So I'm going to share the solved versions with all of you after this session. So you should be receiving it very soon. So once you go back, you can just try your hands in all the working sheets and match your solution. And then when we start the next class, we can always do a recap before proceeding with the subsequent sheets. Thank you. That's it for today. I'm here for any questions that you have on whatever we have discussed.
Thank you, Sid, but please don't forget to send us all of those Excel sheets with your comments on them, please. Okay?
Definitely. I'll do that right away. I'll send it to the admin guy of PreparationInfo, and he should be sharing it with you shortly.
You will be sending the recordings as well, right?
We'll be sharing the recording as well.
Okay, excellent. Thanks a lot. Thanks a lot. Have a good evening.
Great.
Bye.
Thank you. Bye-bye.